Kathy, appreciate your view as always. Kathy Bosantic there of Nationwide. Where we have consensus right now, feels like the committee's on board to reduce interest rates on September 18th. The difference between 25 and 50, I'd say it's pretty big right now for some Fed officials.
Well, Drew Mattis of MetLife just wrote in, and if he were a Fed official, he would be in the camp of, it's a very big difference. He writes, 50 does not equal 2 times 25. And he said they made the same mistake cutting as they did hiking, waited too long, and tried to catch up. Like the hikes, there will be unforeseen problems. And this is what Kathy was talking about with the market, going a bit further even than the Fed is signaling.
And Neil Data touched on some of this over at RenMac yesterday. Go 50 when you can, not when you must. Going 25 risks the same market dynamic as skipping the July meeting. It'll be fine until the next data point makes investors second-guess the decision, fueling bets the Fed is behind the curve, and ultimately pricing even more in again.
And potentially creating that weakness that you were talking about to boot.
Up next on the program, Dan Greenhouse of Solace Alternative Asset Management, Scott Bessent of Key Square Group, Sean Donovan of Enterprise Community Partners, and we'll speak to Ed Al-Husseini of Columbia Threadneedle. The second hour of Bloomberg Surveillance, up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company, where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The
recent volatility has showed us how quickly the market can change.
It's just going to be a little bit harder if you don't get those mega cap names that are contributing more to the index.
We have definitely paired our exposure to stocks overall.
The real question is kind of the speed of the deceleration.
There's still a lot of opportunities to invest in higher quality assets, regardless of the economic environment.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It's a big morning for economic data, live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. Your scores look like this in the equity market. They look nothing like we started the week. Equity futures right now just about positive by almost 0.1% on the NASDAQ, down by 1/10, but some stability in contrast to the volatility of the last 24 hours or so. The day this morning packed. Starts at 8:15, an ADP report. 15 minutes later, 8:30, initial jobless claims. Then after that, 90 minutes following that, the ISM services report. 3 pieces of economic data, the appetizer for the big one tomorrow morning.
And really key to setting the tone at a time where we've seen those jitters exacerbated by yesterday's JOLTS data. Here's the issue, and you asked this earlier, John, and I've been thinking about it for the past hour. This question of, are we just going to see a repeat of what we saw in early August? We got the July jobs numbers. What I thought was interesting about that moment is how quickly we rebounded. Are we going to see as quick of a rebound, which is essentially what you're seeing in markets that seem otherwise pretty resilient?
What we heard from John Stolfus, though, right now, what he views all of this is normalization. That's the debate. Are we actually normalizing? Or to what we just heard from Kathy a moment ago, pace of deceleration. If this actually becomes weaker than the Fed was expecting, could it get away from that?
Well, let's pick up on the John Stolfus point. He wants cyclicals over defensives at a time when defensives are doing pretty decently. Staples, healthcare, and utilities.
Yeah, well, he basically believes that if you end up cutting rates pretty aggressively, that will fuel the next leg of the recovery. We've talked about this, the sort of incredible irony on betting on the recovery before we even get the downturn. Here is the rub of this particular economic cycle. We've had this sort of paddling duck, or whatever you want to call it, you know, swooning swan.
Sure, we'll go with that.
There's this issue of essentially you've got different economies that are moving in different speeds, and so how do you sort of bet on ones that are set to revive just because they haven't been beaten up? Stop looking at me like that.
Looking at you like what? I thought it was just like the perfect way of framing the price action over the last few days. The swooning swan. Okay. Equities right now on the S&P 500. Keep it together. Look like this. Positive by 0.1% in the bond market. Some big moves in the last day. Yields up by 377 to 377 on a 10-year. Compare that to the 2-year at 377. The 2-year, 10-year is almost perfectly flat right now, Lisa. We did this in early August, then it unwound. Are we doing it all over again?
It feels like something is different just because the Fed has leaned into the market's expectations for rate cuts. And that is, I think, the most interesting aspect of this. Do we see the long end continue to increase from here in terms of yield, price lower? Or do we see even further rate cuts? Right now, we're seeing a low of 2.88% of the cycle for base Fed funds rate. Do we see it go even lower? Hard to see. At the same time, you're seeing the likes of Howard Marks saying it should be between 3 and 4%.
This bond market's a paddling duck. Amazing. Coming up.
A swooning swan, actually.
Dan Greenhouse of Solace saying to look beyond the recent sell-off in equities. Scott Bessent of Key Square Group as Donald Trump and Kamala Harris put economic policy in focus. And we'll speak to Ed Al-Husseini of Columbia Threadneedle saying the Fed put is back. We begin with our top story. U.S. equities looking to put an end to a 2-day losing streak as the data builds ahead of payrolls Friday. Dan Greenhouse of Solace Alternative Asset Management saying this: I'm not too worried. Equities are still near a record high with a terrifically fast recovery from the Japan sell-off. We just have to wait for the jobs report. Dan's with us around a table. Dan, good morning to you.
I'm furious. I was not present.
What are you furious about?
For the swooning swan conversation.
Well, we can start.
Why was I not allowed to?
You want to dive in from the top?
Hey. Sorry, carry on.
We can start with markets. Let's start there. What is the show? What has it become? Let's talk about payrolls tomorrow morning. What's a good number? What's a bad number? And how do you expect this market to respond to it?
Yeah, listen, this is a fun parlay game to play, but anything north of 140, 150,000 jobs is probably fine. Obviously, the goal here is to slow job growth, and that's what's happening. And you see this in a number of different areas. The quits rate has normalized, the labor differential. The one pushback I would put to the market narrative is the rise in the unemployment rate. And there's this idea that the 1% increase in the unemployment rate is explained by immigration, by inflows into the job market. And I don't think that's the case. I think, to my eye, it seems pretty clearly that there's job losers. And you don't have to be a PhD. The government basically tells you the number of job losers that there are. And that number's up, call it 800,000 or so over the last year. So clearly the labor market's weakening. A number in that mid-100,000 range is perfectly commensurate with what the Fed is trying to do, what the market wants to see, and I think it's probably going to be fine.
Let's compare and contrast labor market dynamics with financial conditions. Labor market dynamics are somewhat concerning for many people. Financial conditions, when you look at credit and the amount of supply we've had so far this week and how well that supply has been taken down, is there anything to be concerned about at the moment?
In general, the credit market's doing okay. You brought up credit supply. Year to date, high yield issuance is called 30, net issuance is called 30 billion or so. That's flat year over year. IG issuance is doing quite well. There's some asset developments, i.e. some loan issuers are shifting back to the fixed income market to shift from floating to fixed, but generally speaking, you don't really have issue on the issuance front. On the spread front, which I'm sure you've discussed ad nauseum, spreads are still pretty well contained, both for high yield and for IG. So there's no signs of stress there. And even when you go down to the lower rungs of the credit market, where Solis spends a decent amount of time, there's obviously idiosyncratic issues to deal with, but they are by definition idiosyncratic. There's no economic or economy-wide concern that appears to my eye to be festering in the credit markets, likely to spill out into the broader markets.
So let's extrapolate that out. I was talking about the Beige Book earlier because I actually found a lot of nuggets in here that were really quite interesting, including from the Chicago region. Existing businesses were seeking financing to cover higher operating costs because the ability to pass price increases onto customers had sailed. How much do you see a potential consequence to lower rates going forward in fueling an unhealthy bout of borrowing that could change the narrative that we're seeing that is really benign right now in credit markets?
I think that's probably down the road. Right now, with respect to the first point about prices, the consumer staple companies, the packaged goods companies have been telling you this for 6 months now. The Mondeleses of the world, the Pepsis, the General Mills. When you look at their quarterly reports, and any staple or packaged good analyst or investor knows this, all of their growth is explained by prices. Sales volumes have been declining quarter after quarter after quarter ad infinitum. But on the recent conference calls, all of them have told you that consumers no mas. So we know that, and so the Beige Book reflecting that isn't too much of a surprise. In terms of a spate of unwelcome issuance, I mean, sure, but also let's not pretend that interest rates are zero again. I mean, we're still at 5+%. We're on our way, as Howard Marks has said, as a number of people have said, and I would agree, into the 3s and the 4s, granted over a period of time. I don't know that spurs some unhealthy or unwanted borrowing binge. That type of stuff happens, I would argue, in periods of far more ebullience or excitement than I think that we're in right now.
There's a question, Dan, about just the longer term, what we're pricing in, the balance of risks for market players that basically agree with the sentiment that you seem to be putting out here, like a soft landing. Have we overpriced that scenario?
The soft landing?
Yes.
Well, I don't think so. I mean, because right now, listen, these things there's a reason why no one predicts recessions. It's very difficult to do. There's a reason why very few people get famous selling short in front of bear markets. It's very difficult to do. When you look at the data as it presents right now and is likely to unfold over the next, say, 6 months, where you have some semblance of clarity, let alone further out, this is what's happening. The job market is loosening, but not aggressively so. The Fed's beginning to reduce interest rates. There are signs from individual companies that things are getting worse, although I put that in quotes because it's not really particularly bad. So for the immediate future and the present, things are, and I was suspicious of the Fed's ability to do this. So I say this not as someone who predicted this all along, as everyone seems to have been able to do. From my vantage point, the Fed is getting what it wants for now. And so no, I don't think you've overpriced it. You're as an investor, at least from our standpoint, from my standpoint, I'm constantly on the lookout for something that's going to tell me that tomorrow does not look like today. And it's always easy to see in retrospect. So said another way, what am I likely to be upset about tomorrow that I didn't see today? And I don't see that right now. And not that I'm the only one who does this, but I try every day to see where I'm wrong, to re-underwrite my views and my ideas, and by extension, Solis's investments. And I just don't see a reason right now to think that there's some imminent threat to the asset landscape. I just don't, I apologize, I just don't see it.
When it comes to the equity market, you think a lot of this is churn in the larger names, but you also talk about the fact that you think politics is involved. Why so?
Yeah, so on the first point, I mean, listen, the spread between the equal weighted and the market cap weighted S&P that we've all discussed ad nauseum bears attention. Right now, it appears to me to be a lot of AI related selling, NVIDIA, Vistra, those ancillary names. On the politics side of things, I'm not one of these people who thinks that politics dictates everything that goes on in the market. We've all been doing this long enough to know that that's not the case. However, I'm also not immune to observing that the day the market peaked in the middle of July is entirely commensurate with the day that Donald Trump's odds of winning the election peaked as well. And so I believe it was September 15th was the date that the predicted odds of him winning peaked. The stock market peaked on July 16th, just a day later. Obviously, we know that Kamala was selected as the next, whatever, I apologize.
Ordained, whatever you want to go with.
Appointed, anointed, whatever. I'm not trying to be provocative. I don't know the
I understand.
That was July 21st, and obviously the market has struggled since. And I think there are, while I am skeptical that any individual political data point moves the market, we are dealing with the expiration of the TCJA. There are spending and tax consequences for the market as a whole. I saw a headline coming in here that Goldman put out a report talking about what it means for the S&P if the tax rate goes up or goes down, the corporate tax rate. So there are political implications that investors have to wrestle with. And I think based on that observation about the peaking in the odds are indeed wrestling with.
So let's finish where we should start. Capital allocation decisions. Where do you want to be right now, given everything you've just said in the last 8 or so minutes?
Yeah, has it been 8 minutes? It feels like
8
a
minutes.
minute and a half. We're having so much fun.
Too much fun.
I don't think you can have too much fun. I mean, call me crazy, but I think there's never such a thing as too much fun.
I reckon when Lisa started to call this market a swooning swan, I think we're already having too much fun.
But I think it was downhill from there, because how do you beat swooning swans?
Okay, carry on.
I'm trying to finish on the
call. Listen, we still find opportunities in the market, as everyone does. It becomes a relative rather than an absolute game. We have been long the consumer, for lack of a better word, in the sense that the idea that the consumer was always on the verge of collapsing was not something that made sense to us. We are a fund that historically has done a lot of work in the TMT space, particularly media and telecom, and so we still think there's stuff to do there. But on the energy side of things, obviously you have to pay a little bit of attention to what OPEC and the Saudis are saying. But listen, there's still a lot of stuff to do. Commensurate with what I said earlier about the asset landscape looks okay and is likely to continue doing so. We're still optimistic about asset prices and our ability to perform well.
This was great. Appreciate it. Come back soon.
My pleasure.
Thank you, sir.
Thank you so much.
Dan Greenhouse of Solus Alternative Asset Management. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Volvo Cars is scaling back its outlook through 2026. Rising tariffs hurting some of its models made in China. Just yesterday, the Swedish automaker abandoned its 2030 target to sell EVs only. Sluggish sales have hit a growing roster of car makers, forcing them to walk back EV ambitions. The electric transition, particularly in Europe, has veered off course. Governments have scrapped incentives, and a larger customer base hasn't fully materialized. Former Republican Representative Liz Cheney says she is voting for Kamala Harris in November. Cheney says her decision is based on the danger she believes Donald Trump poses. Cheney joins Republicans Adam Kinzinger, former Illinois Representative, and Jeff Duncan, former Lieutenant Governor of Georgia, in endorsing Harris. Presidential nominees Donald Trump and Kamala Harris have agreed to rules for their first debate on September 10th. According to the host of the debate, ABC, microphones will be live only for the candidate whose turn it is to speak and muted when the time belongs to another candidate. Candidates have 2 minutes to answer questions, 2 minutes to rebut, and 1 minute for follow-ups or clarifications. That debate is in Philly, putting the spotlight on Pennsylvania once again. That's your brief, John.
Not even 7 days away, not even a week away. Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, the tax policy pitch.
While we ensure that the wealthy and big corporations pay their fair share, we will tax capital gains at a rate that rewards investment in America's innovators, founders, and small businesses.
The conversation just around the corner, live from New York this morning. Good morning.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you've got something to say,
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
Live from New York City, welcome back to the program. Equity futures on the S&P 500 just about unchanged after a very choppy 2 days on the benchmark in the United States. In the bond market, yields aggressively lower. A move of 10 basis points at the front end of the curve in yesterday's session. This morning, things a little bit softer, cheaper. Yields higher by a basis point. The 10-year, 376.84. Under surveillance this morning, the tax policy pitch.
While we ensure that the wealthy and big corporations pay their fair share, we will tax capital gains at a rate that rewards investment in America's innovators, founders, and small businesses. Now compare that to what Donald Trump plans. He plans to give billionaires massive tax cuts and to cut corporate taxes by over $1 trillion, even as they pull in record profits. We know how to count.
So here's the latest. Donald Trump speaking at the Economic Club of New York a little bit later on today, laying out his fiscal policy plans. Those remarks coming after Kamala Harris unveiled a 28% capital gains tax on people earning $1 million or more, peeling away from President Biden's embrace of a 39.6% wealth tax. Scott Bessent of Key Square Group joins us around the table for more widely considered to be a potential Treasury Secretary pick. Scott, good morning, sir.
Good morning.
It's good to see you. Thanks for coming in. Thank you very much for being with us. Let's start with an easy one. Why do you think that one is a bad idea? The capital gains tax.
The capital gains tax. Look, Kamala Harris is an economic illiterate. Donald Trump is going to give an extensive speech at the Economic Club of New York today. He's going to take questions. She's reading from a teleprompter. And, you know, let's just review here. The capital gains tax will be after a proposed tax on unrealized capital gains, which in the scheme of the new taxes has to be one of the worst tax ideas in 30 years.
Let's talk about how the former president, perhaps future president, might counter that. What are his policies?
Well, I think you're going to hear from President Trump today. You're going to hear a warning that the Harris-Biden administration caused the great inflation. Vice President Harris was the tie-breaking vote on both spending bills that led to the inflation, the inappropriately named Inflation Reduction Act and the American Rescue Plan. They would not have passed without her signatures. I'm still not sure that she knew what she signed, but she did sign it. And, you know, all these policies that she's talking about now, are going to ignite inflation again. Because what happened last time was we got a demand shock from government spending that was met with high levels of regulation, and that's the recipe for inflation. You know, in Trump 1.0, we got a demand shock from the private sector fueled by the tax cuts, and that was met with deregulation, and that's why we had non-inflationary growth. President Trump's going to talk about that again. He's going to talk about energy dominance. He's going to talk about not only stopping the inflation rate, but getting prices down, which I think is very important for the American households. You know, we're in an affordability crisis. And he's going to address getting the deficit down. I mean, we are at 7% peacetime, non-recessionary deficits, and it is clear now, I think I said it last time when I was here, I've been saying it for about 2 months, that the economy is slowing dramatically.
Scott, how do you get the deficit down when, if you look at Trump's policy proposals, floating a corporate tax rate of 15%, campaign is also floating excluding Social Security payments from taxes, exempting tax on tipped wages, also increasing the child tax credit. All of this is going to add to the deficit. Plus, tariffs, which some economists will say is inflationary.
Well, let's unpack that. There would be income from the tariffs. Right? So, that's a big number.
Well, that's debatable, though, because some say that's just going to be
years.
passed on to consumers.
Well, all taxes are passed on to consumers, and I think what's interesting about taxes is they aren't necessarily inflationary. They're a one-time administrative price adjustment. Historically, 40 to 50% of any upward impulse is reflected in the currency, so that would offset it. Then we have the various preferences by consumers. It could end up in foreign manufacturers' margins. Their margins could go down. Their elasticities, consumer behavior can change. But in terms of getting the deficit down, I have been talking about it before. I think we would freeze domestic programs except for defense. If you look at the Harris-Biden proposals, and she hasn't walked this back yet, maybe she will, they're calling for a 21% decrease in defense spending. I can't imagine a worse time to do it. The only thing that I believe, and again, I don't speak for the campaign, but the only thing that I believe that should have real increases is defense. The Inflation Reduction Act is the doomsday machine for the deficits. It was originally scored at a positive score. It was supposed to be positive 50 billion. Then it went to 300 billion. It's probably going to be $1 trillion this year, and it's now estimated over the life of this thing that it could be a $4.5 trillion hole in the deficit.
So hold on a second. Does that mean that you expect Donald Trump to try to unwind it?
Put a halt to it.
Okay, but not unwind it.
Well, I'm not sure what unwind means. You're not going to level the 8 charging stations that we got for $8 billion.
I guess here's the question, and this is the reason why you had the Congressional Budget Office come out saying that Donald Trump's proposals will actually increase the deficit more than Kamala Harris's. We had a story on Bloomberg talking about how potentially Donald Trump's proposal could increase the collective cost as much as $10.5 trillion over the next decade. I mean, how do you offset that?
Well, first of all, and you all know that Bloomberg is one of my favorite venues, but I do have to say that that story yesterday in the $10.5 trillion was poorly written, poorly edited, and compared apples to oranges. The $10.5 trillion was everything Donald Trump and J.D. Vance have ever said, and they took it to the highest end. Then they took a score from the Wharton School and said, well, this is the Harris budget or the Biden-Harris budget. It's apples and oranges. If we were to take everything that Vice President Harris, including what she said in Raleigh, $25,000 for housing, including for new arrivals, that would be substantially in excess. So,
but the Democrats and Biden's budget now and Kamala Harris as part of this administration have revenue increases. Where are the revenue increases to offset all of these tax cuts that Trump is talking about?
Well, look, I think there are pay-fors here. Right? So it's to cut spending. We do not have, Anne-Marie, we do not have a revenue problem in this country. We have a spending problem. So traditionally, the government revenues, federal government revenues, are 17.5% to 19% of GDP. We're right there now. Since 2000, we've averaged about a 3% budget deficit. So spending has been 21, 22%. This administration, led by Vice President Harris, has blown out the spending. We're at a 7% budget deficit right now, and what do we have to show for it? We had job We had the employment numbers revised down by 800 or 900,000 jobs. We had 250,000 private sector jobs. So the idea here is what we have seen with Harris-Biden. It's what's called in Grand Prix driving, two-footed driving. You've got 1 foot on the accelerator. The Fed is putting 1 foot on the brake.
Scott, forgive me because I've got 10 seconds left. I don't want to cut you off, so just stick around. Scott Bessent of Key Square Group from New York. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Let's get some price action. Equity futures right now positive by 0.1% on the S&P 500. On the Nasdaq, we are just about negative. Let's call this unchanged. Things are settling down. Lots of economic data through this morning. 8:15 an ADP report. Initial jobless claims at 8:30. Then later on in the morning at 10 a.m. Eastern Time, we'll get the ISM services read. In the bond market, a big rally to start the month of September. The 2-year settles down at 376, up by about a basis point this morning. The 10-year up by a single basis point too. 376.65. And 3 days of yen strength. Can this continue? Dollar yen looks a little something like this. At 143.51, we're negative 0.1%. Typically, we talk to Scott Besson at Key Square Group a lot about politics, given his potential to be the next Treasury Secretary. Scott, we've also got to talk about what's happening in this market because you've got positions in it. I know that you've been long gold, you've been long the Japanese yen. Are you keeping those positions?
I am, and thanks for focusing on my day job. I think in the Japanese yen, it's an extraordinary opportunity because as central banks around the rest of the world are in an easing cycle, Japan, for the first time in almost 2 decades, is in a hiking cycle. So, we'll see if they're like cicadas, they only come out once every 17 years, or whether this turns into a real hiking cycle. My thought is that there is the potential for this to keep going.
So you want to keep riding this trade. We're at 140 now. We were pushing through 160 previously. What kind of numbers have you got in mind?
Well, it's two sides to this. Japan is strengthening, inflationary impulse is picking up. The other side is, as I've said, the U.S., I believe the U.S. economy, I said it recently, is buckling, and we're starting to see it in the numbers. I think it's both industrial numbers and labor. And I think what's funny here, on the Democratic side of the aisle, and I will put politics back in for a minute, they've been screaming for a rate cut all year.
Yeah.
Now, even Claudia Sahm, who's been chewing off her arm since February for a rate cut, doesn't want to come out and say, well, my rule got triggered, and anytime my rule gets triggered, we're in a recession. So they don't want to use the R word before November 5th.
So the longer Nippon Steel waits, the cheaper this deal gets, right? Potentially for them.
Well, yes, exactly. They may have, through some terrible timing, get a better price. We'll see what happens.
Walk me through what you think should happen, and let's finish there. Harris says she wants to block the deal. Biden's given a signal he wants to block the deal. The former president's given us the signal he wants to block the deal. The company has come out to the Wall Street Journal in the last 24 hours and say, if you block the deal, job losses are on the table. We're going to be moving out of Pittsburgh. How do you recalibrate the policy now with that in mind?
Well, I think we've seen, and it was very surprising because I've been going to Japan since 1989, and Japanese companies traditionally have a very high regard for all stakeholders. I remember the first time I went and talking about shareholder value, and they said, oh no, Besson-san, we have our customers, we have our employees, we have our banks, we have our community, and the shareholders are last. And now, they've reversed that. They're putting shareholders first. And I was surprised to see a Japanese company that didn't check in with the U.S. stakeholders. They didn't check in with the community. They didn't check in with the unions. They didn't check in with the customers.
That's the mistake they made, Scott, and this is where we are.
Yep.
And now we've got to deal with the policy on the campaign trail. Are we going to offer them state aid? How do we keep this company in business in a way that doesn't end up with job losses?
Well, look, I think that maybe the deal will be resurrected. Cleveland Cliffs actually forced Nippon Steel's hand with their bid, so maybe a domestic buyer will come back.
You don't see space for state aid?
Sorry?
You don't see space for state aid?
Well, I don't see why we need it right now. Look, we did state aid with Intel, and Intel just laid off 15,000 employees. The stock's down 60% this year, and they're probably going to be pushed out of the Dow.
They got their own problems. Scott, it's good to see you. It's nice to touch on markets too.
Yeah.
Let's do that again next time.
I like
Scott
my day
Besson's
job.
at Key Square Group. We like your day job too. Thank you, sir. Equity futures right now on the S&P 500 positive by 0.1%. Let's get you some top stories. Under surveillance this morning, President Biden preparing to block Nippon Steel's $14.1 billion takeover of U.S. Steel, with a decision expected as soon as this week. This despite U.S. Steel responding that it intends to pursue all possible options under the law to ensure the deal goes through. That stock is bouncing back by 2.4%. As we mentioned a little bit earlier, Donald Trump set to detail his economic agenda in an address today at the Economic Club of New York. The Trump campaign saying the Republican nominee intends to cut wasteful spending and increase energy production to pay for the $10.5 trillion it's pledged in tax cuts. There's a lot of tax cuts on the table. They're going to cost a lot of money.
It feels like it's Oprah Winfrey and tax cuts. Everyone across the board seems to be getting some sort of tax advantage. The issue is how are they going to pay for it? Scott Besson just there said potentially tariffs. Is that really going to pay for this $10.5 trillion potentially of tax cuts? We also should mention the Harris campaign is also talking about some of these tax cuts, but those making under $400,000. She is still sticking with some of Biden's ideas of raising revenue at the top.
At least we can actually have a debate about this in the next week or so. Trump and Harris agreeing to an agreement over the rules for their first and only scheduled debate, set for next Tuesday on ABC. Harris reluctantly accepting that microphones will be turned off during the other candidate's turn to speak. Trump saying Wednesday he plans to allow Harris to speak without interruption.
Yeah, by de facto, since the microphones will be off. Look, how much will we actually get, and how much will this be? Who has a better vibe? Because we basically have only gotten vibes for the most part, since a lot of the proposals that we've heard about are mostly dead in the water, depending on the composition of Congress. To me, this will really define whether you have Kamala Harris as the underdog candidate or not, whether you have Donald Trump still very much the preferred winner by a lot of companies. This is going to be a really important seismic moment at a time where people can already start voting. I think that point cannot be lost.
Yeah, let's talk about one of the issues that's bound to come up next week. Two key data points ahead of the Fed's September decision, kicking off with payrolls tomorrow and CPI next Wednesday. Housing costs remaining a top concern for many, including the former Secretary of Housing and Urban Development, Sean Donovan. Sean is the current president and CEO of Enterprise Community Partners and joins us now. Sean, good morning to you.
John, great to be with you.
Thank you very much for coming on the program. Let's just talk about the scale of the affordability crisis that you've been talking about for a while and we've been living through. Are we finally coming out the other side of this?
I don't think so. And in fact, it's getting worse in places. I've been doing this work a long time, about 30 years. And I think what is different is really two big things. First, it is a problem that is deeper than it's ever been. We have the biggest rent increases we've ever seen. We have a doubling in what it costs to buy a home in the country in the last few years. But the problem is also everywhere now. It used to be on the coasts. It used to be in our bigger cities. I was in Boise, Idaho last week, and they have a housing crisis there. And so it really is everywhere. It's also driving our economic challenges in a way that I've never seen nationally. Our inflation problem is a housing problem now. You have companies who can't attract workers, and it's driving down economic growth. Half of all our renters in the country are paying more than 30% of their income, which is unaffordable. That's $8,000 a year they could be putting toward groceries, consumer demand. And so it really is at a different scale. And it's in our presidential campaign right now. 33 governors across the country talked about housing affordability in their State of the State address. So it really is a different crisis than I've ever seen. And it is moderating from COVID, but at a level that is unlike anything we've ever seen.
I'll ask a dumb question and you can give me a complex answer. Are we 200 basis points away from solving this crisis with a few rate cuts?
Absolutely not, because we are 7 million housing units short of what we need. This is a supply problem, not just a rates problem. And that means we've got to take action in many, many different ways, both on demand and on supply.
When you listen to the campaign trails, both of these individuals sound populist in nature when they talk about the housing market. Kamala Harris saying first-time buyers can get $25,000, a benefit to help them. Don't you think that would exacerbate the problem we are seeing right now?
Well, let's be clear. Harris's plan does both. It focuses on supply. It looks at overregulation. It looks at the need to encourage states and locals, even require them to build more. But we also have to recognize that for a family, that the real struggles are for families who can't even put food on the table. We have a record homelessness crisis. And so we do need to figure out how to help people afford housing more. We're never going to bring that cost of housing down enough that most people can afford a decent place to live, right? So, and that's really, you have to have a balanced program.
It also doesn't matter what Trump or Harris say, because this will be done in Congress. How could you see potentially a divided Congress get to any resolution on something like housing?
Well, this is what's so interesting about the way the politics have changed on housing. I said earlier, 33 different governors. I've been in Boise, Idaho, and Montana the last few months. Red states, blue states. Give you another example. We had a tax bill that made it through the House of Representatives overwhelmingly. The most bipartisan thing I've seen. There was a significant increase in the low-income housing tax credit, the best public-private investment vehicle we have to build more affordable housing in the country. And so I think this really is a moment different from what we've seen in the past, where there is bipartisan support around housing. And I think in the tax negotiations next year, you're going to see a big increase in the low-income housing tax credit.
As those policy discussions continue, and presumably will take some time, going back to John's point, if the Federal Reserve cuts by 200 basis points in the next 12 months, will that make the home affordability crisis worse or better?
It will definitely help. It will make, obviously rates are a critical thing, not just for home buyers, but for builders out there. And so that will be important. But I want to go back to the fundamental problem. For many, many years, we've been lagging on building housing. And the supply problem has got to be focused on if we're really going to get to the solution.
You talked about how this is a problem that's widespread, and you talked about U.S. cities, but it's widespread globally. And actually, cities across the world are dealing with this affordability crisis, and a lot of people are saying it's because of how low rates got, and because a lot of people could leverage up their home purchases, and thus lead to higher prices. Why won't lower rates just do that again? We've already seen home builders building as fast as they have in a very long time during the pandemic, during high rate times. So what's to say that they're going to keep up?
Because we have to recognize that housing is a financial instrument, but you can't build it if you don't allow zoning to build that. So in a neighborhood where a community is saying, not in my backyard, I don't want any more housing, there are different measures of it. Harris's plan says she would add 3 million units. Our numbers are for real affordability. We have 7 million units shortage. So rates are just a piece of the issue, but fundamentally what we allow to be built and how we, for the lowest income people, how we support them to do that is critically important.
You're an expert in this with a lot of experience, a lot more than anyone around this table, that's for sure. Harris is offering two things, wants to incentivize building, but also support buying. And I think we all understand there is a mismatch in the time horizon for those two policies to bear fruit. You can support buying, that works immediately. The supply issue is going to take years to play out. In the near term, don't you risk higher prices with these kind of policies?
You have some risk, but understand, for a family that is right now spending half of their income towards rent or to own something, that increased support might mean they put more food on the table. It might mean that they do other things to support their family. So it has some effect, and there is some risk to what you're talking about. But at the end of the day, we know we have to do both. We have to support supply and demand. And I do think what's exciting right now is you have a consensus around the country for Democrats and Republicans that we have to build more. Here in New York, we have a City of Yes proposal. In Montana, they just passed legislation that says cities can't restrict housing development in certain ways. So that is a growing momentum. And you're right, it will take time. So we better get started.
How long has this problem been building for? Maybe we can finish here and just give you a big picture opportunity. You were part of the government coming out of the financial crisis, the housing crisis, 08, 09. Were the problems now, were the seeds planted back then, the lack of supply? How connected are these two issues?
So what I would say is this has been a chronic problem over decades. Housing affordability has been getting worse for probably 50 years in this country. But it's really become an acute crisis through COVID. COVID gave it a jolt of adrenaline in terms of making the problem worse. I want to go back even before the Obama administration, given that we're on Bloomberg TV. I was Mike Bloomberg's housing commissioner here in New York City. Yep. And this was a huge focus for us, is taking old industrial areas, rezoning them. Right now, we have 1 billion square feet of empty office space around the country. That's an opportunity to really think about. So absolutely, this is a problem that's been building, but it is different now in terms of what we saw during COVID. People are demanding, those people who used to work in an office, they're now working at home, they're demanding more space at home. And so we have a demand that's grown enormously during COVID that we have to meet.
This was super smart, and we look forward to doing it again with you. Thank you, sir. Pleasure being here. Appreciate it. Sean Donovan there of Enterprise Community Partners. Let's take the opportunity to get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Nikkei reporting that Seven & I, the Japanese owner of 7-Eleven, will send a letter to Couche-Tard saying that its offer price is insufficient. The Canadian company launched a takeover approach a little over 2 weeks ago. Seven & I is also expected expected to tell Couche-Tard to reconsider the price, and that concerns remain about competition law. The company did not immediately respond to a request for comment by Bloomberg. Matt Damon and Lin-Manuel Miranda will headline a campaign fundraiser for VP Kamala Harris. An invitation obtained by Bloomberg shows that the dinner takes place in New York on September 18th. Tickets are going for $25,000 a person. Harris's campaign has been leaning on celebrities, trying to expand her cash advantage over Donald Trump. And Olympic breakdancer Rachel Gunn has apologized to the breakdancing community. Gunn rose to viral infamy with her performance at the 2024 Paris Olympics, where breakdancing made its debut. The Australian lecturer, who goes by Ray Gunn, showcased moves such as a backwards roll, a kangaroo hop, and different contortions of her body on the floor. During an interview on Wednesday, Gunn said she is very sorry for the backlash that the community has experienced due to her performance. Breakdancing will not be in the 2028 Olympics. That's your brief, John.
Danny, thank you. Actually felt like it was very inclusive. For the first time I watched breakdancing and felt like I'd replicate the moves, didn't you?
In fact, my children did replicate the moves ad nauseum at home.
There you go. You shouldn't apologize. Up next on the program, all signs pointing to rate cuts.
We've been on the hunt for a while for the Fed to get started with its rate cutting. Rates at the current levels are too restrictive, given the slowdown in activity that we have seen this year.
Bramo's doing the moves. Is that the move?
Oh, that's one of them.
Oh, nice.
The kangaroo.
Yeah. That won't be up next. From New York, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities just turning lower, just a touch. We're down by almost 0.1% on the S&P. In the bond market, yields higher. After yesterday's rally, we bounced back a single basis point, 376.84 on a 10-year. Under surveillance this morning, all signs pointed to rate cuts.
We've been on the hunt for a while for the Fed to get started with its rate cutting. We actually think that rates at the current levels are too restrictive, given the slowdown in activity that we have seen this year. It's more likely that what we'll see is a 25 basis point cut, but a bit more forward guidance around how they are seeing this evolve and what might cause them to actually get more aggressive.
So here's the latest. Traders looking ahead to a double dose of labour market data today, with ADP payrolls and weekly jobless claims just around the corner. Ed Al-Husseini of Columbia Threadneedle writing, the Fed put his back. One of the key unknowns is how the economy will respond to the Fed executing rate cuts. If the pass-through of cuts into the real economy is slow, the Fed may find itself behind the curve once again. Ed is with us around the table for more. Ed, good morning and welcome back.
Hey, fantastic.
You said in your recent note that market pricing masks a broad distribution of outcomes. How wide are the range of outcomes right now?
Yeah, I mean, it's striking. If you look ahead, we're starting to price well in excess of 100 basis points this year. And if you look into the end of next year, the probability that Fed funds manages to stay at around 4% is close to zero. So it's a fantastically broad distribution at the moment and getting broader every week.
And there's a feeling it wouldn't take much weak economic data to really amplify some of those bets, that if we drop to 100K tomorrow morning and unemployment stays at 4.3%, we start pricing in a series of 50 basis point cuts. So if you're facing these kind of outcomes and the range is like this wide, you can drive a truck through it, do you chase this bond market rally? What do you do with this?
Well, I think we've had a really strong rally so far this year. I think what we want to do is take stock that the starting level of yields is still quite attractive, that the curve is likely to continue to steepen versus what markets expect. And so that gives us a little bit of juice. At the same time, I don't think you want to be maxed out. I think you want to leave a little bit of dry powder for an environment in which the data manages to surprise us to the upside.
I was struck by the fact that you hear the likes of Howard Marks saying that the neutral rate in this new environment is something like 3 to 4%. But if you look at this wide spectrum of potential outcomes, you actually see an average rate below 3% by 2026. Do you think that that's maybe overestimating the chance the Fed really does get down to close to zero again?
Well, I think there's a really strong probability that that happens in the coming years. Right, that the data deteriorates to the point where unemployment starts to feed on itself. You get those recessionary dynamics. In that environment, the odds that the Fed funds rate goes to zero, I think, is exceptionally high. And Fed research does continue to point to that probability being high in the coming decades. Will it happen in the course of the next 12 to 24 months is anybody's bet. We have a significant amount of fiscal uncertainty on the flip side of this election that may forestall a recession. But if the dynamics are there, Fed funds going back to zero, I think, is a very reasonable assumption.
There's a pretty profound sort of extrapolation that I'm feeling from you, which is that essentially this is not a different environment than pre-pandemic. That essentially this is not a more inflationary time than we were in 2019 and 2018. And this flies in the face of what a lot of investors are saying, including some pretty big ones. Can you explain why you think so?
Yeah, look, I think the large part of the inflation story, and again, this goes back all the way to the mid-90s, is driven by anchored inflation expectations. We've run this massive experiment on the course of the past 3 years, the extent to which those inflation expectations form a center of gravity that pulls inflation towards 2%. And I think it's played out really well. It's underscored the Fed's credibility in maintaining that level. I don't see any reason why inflation should be different going forward unless the Fed's strategy changes. Inflation, at the end of the day, is a financial variable determined by the Fed.
If the Fed cuts by 50 basis points, then 50 basis points again at a time where the economy is not falling off a cliff, isn't that the variable that could cause a higher inflationary environment?
We're going to find out, right? If, in fact, that neutral rate is closer to 4%, that means the economy is going to be very sensitive to rate cuts straight out of the gate, right? 100 basis points of cuts could significantly accelerate growth, could put upside pressure on inflation, and then we're not going to get, Fed funds below 3.5% in the coming 24 months. This is a key unknown. We just don't know at this stage, given how much flux we've had in the course of the past 2 to 3 years.
I'm pleased that Ed has said all this because you have to realize how finely balanced things are going into tomorrow morning. We're one bad jobs print away from pricing at a series of 50 basis point cuts and one good one away from reversing a lot of what we've priced in over the last few weeks.
And essentially, what we don't know is what the responsive markets will do to the underlying economy. We keep talking about how this isn't a very interest rate sensitive economy, as many people expected, on the way up. What's to say it will be on the way down?
Should I fear the disinversion? Can we finish there? When the curve starts to normalize and you get this bull steepener, typically that means bad things are about to or are happening in the US economy. The rate cycle is just about to start or is happening. What is it this time? Could it be different this time?
Not as much. I look at the curve and I see In the course of the past, again, 12 to 24 months, the curve was deeply inverted, signaling that the Fed has taken us to a very restrictive place. They're taking the foot off that brake pedal right now, and the curve is disinverting. The pass-through into the real economy, I think, is an open question, right? You had your previous guest talk about the sensitivity of the housing market, housing capex, to those interest rate cuts. It's a key unknown to this day. If, in fact, we see that housing demand come back, housing capex come back, on the flip side of the election, potentially corporate capex reaccelerate, the Fed's going to have a really high floor in terms of other cuts relative to what's priced today.
Ed Smart, as always, thank you, sir. Ed Al-Husseini there of Columbia Threadneedle. He's right. We still don't know whether those rate cuts will ultimately unlock a ton of inventory, push out supply, or whether the actual biggest impact will be on demand. We still don't know. Are prices going up or down off the back of these cuts?
But that's exactly it, right? We don't know exactly what the circumstances are, what the data is going to actually be, how much has already been priced in, and some of the interest rate sensitive loans that consumers take out, how many more of those could actually get extended by virtue of rates coming down in a way that's not Wall Street focused, that's more Main Street focused and leads more directly to inflation.
If you are just joining us, the third hour of Bloomberg Surveillance just around the corner. Futures currently just slightly negative on the S&P 500. The third hour looks like this. We'll catch up with Kate Alhillo of Russell Investments, Tim Natanas of Wolfe Research, Jay Bryson of Wells Fargo, and Kathy Jones of Charles Schwab. From New York, this is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
We actually think that rates at the current levels are too restrictive, given the slowdown in activity that we have seen this year.
We're not expecting a collapse, but there is no doubt the consumer's slowing.
Not much has changed with the consumer over the last 6 months. They're employed, wages are growing, but they are being choiceful.
The direction of travel is towards a weaker economy. We shouldn't be surprised by this.
Growth looks good now, but we do see slowing going forwards.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. So let's set up the third hour of Bloomberg Surveillance at 8:15 Eastern Time, an ADP jobs report, 8:30. 15 minutes after that, jobless claims. And then after that, 90 minutes later, 10 a.m. Eastern Time, you get the ISM services print. 3 key data points going into the payrolls report tomorrow morning. And Lisa, it begins in 15 minutes.
And it really is the key test of how strong is this Fed put? Essentially, how much will people be looking at any bad news data as seriously problematic and any good news data as simply being good, not necessarily abnegating what the Fed is poised to do, which is cut rates quite considerably. So to me, this sort of is what has been behind this broadening out and whether that can continue.
I was also struck by what Ed just said just a moment ago. Basically, if the Fed if all this pricing in is 100 basis points, right, is there a chance that if the Fed were to actually do that, could that reaccelerate growth and have this concern about inflation? And this is still a debate for some members. Look at what Bostic just said yesterday, the fact that loosening monetary policy prematurely is a dangerous gambit. At the same time, Mary Daly is basically like, we must protect the labor market at all costs. And she's not sure yet whether or not it's 25 or 50, but she's there.
To pick up on Ed's point, the market pricing, we often talk about market pricing and how much we're pricing in for September and beyond. Market pricing is the aggregate, the average. We're pricing in whatever. It masks a broad range of distributions. And this is ultimately what he's talking about. Ed's saying that if we get a bad print here, you could be pricing in a series of 50 basis point cuts just like that. You get a good one tomorrow morning, you risk reversing pretty much everything we've been pricing in over the last couple of weeks. That's how finely balanced everything is at a time when the Federal Reserve has said repeatedly they're not data point dependent.
He also highlighted that we just don't know the answer to a lot of these very profound questions, such as what is our destination? How inflationary is this economy? How responsive is this economy to rates at a time when people were surprised that it didn't fall off a cliff, to how high the Fed raised them? They're all fundamental questions. As he said, we just do not know the answers, and it's the reason why Fed officials aren't really giving us much guidance, because they don't know either. They don't have a crystal ball.
We don't have one either. So the data drops in about 13 minutes, and all of a sudden the ADP is important again. Mike McKee's going to break that down for you in just a moment. Equity futures on the S&P a little softer. We're down 0.1% in the bond market. Yields a little higher, up a single basis point, 376.27. Coming up this hour, we'll catch up with Kate Alhillo of Russell Investments as markets await the next batch of labor market data. Tim Natanas of Wolfe Research as Nippon's bid for U.S. steel all but collapses. And Kathy Jones of Charles Schwab on why all roads lead to lower yields. We begin with our top story. Stock steady ahead of more labor market data. Claims coming in just under 30 minutes time ahead of August payrolls tomorrow morning. Traders looking for evidence the Fed has stuck the soft landing. Kate Alhillo of Russell Investments saying the inflation problem is largely solved at this stage. Expect we'll hit the 2% inflation target in early 25. The Fed has the space to be aggressive if needed on rates. We still expect a soft landing, but we can't rule out the possibility of a recession. Kate joins us around the table. Kate, good morning to you.
Great to be here.
Thanks for joining us. Let's start with payrolls tomorrow morning and the data through the next hour or so. What are you and the team looking for?
Well, we're looking for a beat on what we saw certainly in July and something close to like the 145, 165 range. And if we get something close to that, we think the market is pretty positive. Continue to see some of this broadening out. Any chance that we are below 120, below 100, that's where you start to see some material volatility.
So good news is good news, and bad news is definitely
it's really bad news.
Bad news. Talk to me about where that would leave the bond market tomorrow morning.
Yeah, so I think, again, I don't think the bond market's moving tremendously unless you see the labor market really start to show more signals of a weakening versus a normalization, and then potentially start the recession discussion to be more prominent. We're not there yet, but if you start to see some challenging prints in terms of labor, that's where you start to see some movement.
This is really interesting to me. You think it's an asymmetric response, that essentially
Yes.
people are not going to unwind what we've seen in terms of the rally in the bond market. What gives you that conviction?
Yeah, well, I'd say a couple things. First, I think the first 100 basis points of cuts, whether it happens this year or it kind of drips into next year, is kind of easy to get to. The 200 or so that's being priced in through the end of next year, that's where you might see some movement still, but you still end up having like terminal rate. You still have a while to go to get there. So again, I think if you get some good news, the labor market's more normalizing. July was maybe a little bit of a misshoot, but the Fed is still moving to focus on the labor market and not inflation, that you don't end up seeing a big shift back up in rates, because we know that the direction is pretty clear.
We were talking about the incredible volatility of markets at a time where there are so many unknowns, and there just is this feeling that one data point could really tip the scales in a pretty significant way. Do you basically view bad news as being a buying opportunity? I mean, if you end up seeing a negative, some really problematic print, can you say, look, you look at the fundamentals, you look at these companies that are performing pretty well, all right, time to buy?
Yeah, I mean, I'd say a couple of things. It's great to actually see volatility back in the market and the market reacting. I think the challenge is it's overreacting to single points or news. And so we're staying pretty close to home in terms of our strategic allocations. So if we see those overreactions, we are leaning into them. It tends to be more as trimming our winners, i.e. even when rates have moved up or moved down over the past period, we've been trimming. If we see a big sell-off, we'll be leaning in. But I think it's more because the overreaction that we're seeing from the markets because of the volatility and the uncertainty. The market's still trying to find kind of the narrative.
When you say trimming in the bond space, and then we'll go to the stock space, are you basically saying that the market has priced in too many rate cuts?
Yeah, so we think that the magnitude right now is at the point where it's probably as much as it's going to go unless we start to see a recession theme start to pick up. So we have started to trim some of our duration positioning.
You know Connor Sen, Bloomberg Opinion?
Yeah.
Love Connor Sen.
He's great.
Check out this tweet. If the Fed was unburdened by what has been, get it? Fantastic. And if the Fed had a blank sheet of paper to begin with, they'd probably set Fed funds around 4% instead of where we are right now. Instead of this performative chatter from various people about the signal it would send if they cut by 25 or 50 and the anchoring to 525 to 550, can we play that game? Just some scenario analysis. If we were to have a blank sheet of paper at the Federal Reserve, what would the rate be today?
425, 450?
Yeah. So we're about 100 basis points offside of the Fed.
Yes, yeah, which is why I'd say the first 100 basis points is easy to get to, so you don't see as much movement. It's the stuff further out that we're still trying to figure out in the magnitude of how far they go.
We've heard that number a few times, haven't we? That maybe they're 100 basis points offside. So to Connor's point, what is this performative chatter about? The signaling from 25 versus 50. If you're offside, get a move on and just say you're offside.
Isn't the Fed, and this isn't meant as a pejorative, but isn't the Fed essentially a performative instrument? Isn't it sort of the signal that they give to markets?
They behave that way, yeah.
Well, and so at a certain point, and that really goes to this question of how do you trim positioning? How do you understand whether they're on a trajectory that's much steeper, akin to what Ed Al-Husseini was talking about, where they could go back to zero, versus between 3 and 4%?
Yeah, and I think that that's where you don't make any kind of severe moves, because there is a lot of uncertainty, and try to take advantage of the volatility.
Kate, this was awesome. Busy 24 hours ahead for you and the team. Thanks for dropping by.
Thank you.
Thank you. Kate Arhilla there of Russell Investments. If you are just joining us, welcome. Equity futures a bit softer. We're down by 0.1% on the S&P 500. Just the guidebook, the roadmap for the next 45 minutes or so. In about 7 minutes, we get the ADP jobs report. Jobless claims 15 minutes after that. ADP, I had a question earlier this week. I've been leaning on this question a few times. I've been asked a few times whether ADP is more important than payrolls this week because of the revisions we had a few weeks ago to payrolls, and that maybe, dare I say it, not my words, but perhaps, it's a question, not a statement, perhaps, maybe, let's ask the question, is the ADP more credible than the payrolls report this week?
Okay, honestly, how can you back away from a statement before you say it more than what you just did? But honestly, that's what we've heard from a lot of people. I've seen a lot of notes saying the same thing, that essentially ADP has been more on par when you take into account some 880,000 jobs that were removed from the year of job gains through March. It's a valid question. Point being, will you see more of a reaction in markets than usual with ADP? Stay tuned in 6 minutes.
Mike McKee's going to break it down. There's your tease. It's a great tease. Put that in a promo. Let's give an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. French President Emmanuel Macron has picked the country's next prime minister. Michel Barnier, a senior conservative figure and the EU's former Brexit negotiator. By choosing Barnier, Macron is opting for someone who largely avoided the bickering of a contentious political environment in France as of late. He faces the immediate challenge of forming a cabinet that can bridge the rifts between the left, right, and centrist blocs in parliament. JetBlue shares moving higher in the pre-market trade by nearly 6%. The carrier raised its sales forecast for the current quarter. The results are in part thanks to passengers who rebooked flights that had been canceled by rival airlines when an errant CrowdStrike update caused an industry outage in July. Third quarter revenue will be between 1% to down 2.5%. Its prior expectation was as much as a 5.5% decline. And Shoe Carnival reporting second quarter earnings, the stock gaining 3.2% after narrowing its forecast but pointing to back to school season momentum. Lisa spoke to the Skechers CFO from the Goldman Sachs retail conference.
Over the last year, things have settled out, but they haven't in any way pulled back in a meaningful manner. I know that's inconsistent with what you've seen across the broader market, so I think in part that's due to the innovation that we're bringing in our brand to the market. But in terms of a major pullback, no, we haven't really seen that yet.
Also different than the wider market, Skechers said that it sees long-term opportunity in China. And that's your brief, John.
Danny, thank you. Thank you very much. Lisa, you were there with the Skechers CEO. Compare and contrast that with what we're seeing elsewhere from companies suffering and struggling in China.
Yeah, well, that actually was shocking to me, and they were not alone. On Holding also talking about how they too are seeing opportunity to expand in China. When you talk about tariffs, when you talk about things like that, got to keep an eye on it, you know, et cetera, et cetera.
Yeah.
But this is a pretty big market, and they talk about how they have local businessmen running their businesses. Just doesn't seem to be moving away from that in a material way.
Did you get any sneaker vouchers?
No, but I did ask him.
Giving away Skechers at the conference.
I did ask the Skechers CFO how you make Skechers cool.
And what was the response?
He also has teenage kids.
Who asked the same questions, yeah?
And they asked the same questions, and then he started talking about the factories and innovation.
Okay, you can tell us what you really said in a moment.
No,
right?
really, that's it.
Okay, all right. Up next, the Monaco's Plus. Tim Natalis of Wolf Research as Nippon Steel goes after US Steel, and they hit a major roadblock in Washington, D.C. All of that and an ADP report just around the corner from New York. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
The economic data begins in just a few seconds. We get an ADP report, then after that we get jobless claims, then it's the big one tomorrow morning, 8:30 Eastern time. The payrolls report, we are looking for a number of 165, the median estimate in our survey. Your scores going into this data, negative on the S&P by almost 0.1%. On the Nasdaq 100, softer by 1/3, adding to the losses of the last couple of days, kicking off September in the wrong way, that's for sure, for the equity market bulls. Switch up the board and turn the page, and we'll turn to the bond market as we get a downside surprise on the ADP report. Yields are dropping to 373 on a 2-year. Mike McKee, the wrong kind of downside surprise on this number.
The wrong kind of downside surprise, unless you are betting that the Fed is going to be cutting 50 basis points, because you've got 99,000 jobs, according to ADP, created in the private sector during the month of August. That is far lower than the 145 anticipated. Remember, we got 145,000 total jobs, 114,000 total jobs in August from the government, and the expectation has been that that would jump up, but it has not jumped up, at least not in the ADP numbers. Now, ADP has revised down their July numbers to 111,000 from 122,000. So definitely a disappointing number. And given the fact that we have seen markets react to much less lesser jobs data this week, I would imagine this is going to scare some folks.
So equity futures just a little bit softer, not too much drama actually, Mike. We're looking at futures down by a little more than 0.1% on the S&P. Yields were a bit higher early this morning, now they're lower. If you switch at the board and go to the 2-year, the 10-year, the 30-year, we can just take a sneak peek of things to the front end of the curve. We're down a basis point or two now to 373.73. In foreign exchange, dollar yen around 143.13. But Mike, there are some people out there wondering whether ADP is a better signal of where this economy's at compared to payrolls, which got revised so heavily a few weeks back.
Well, remember that ADP is revised a lot, too. We just don't pay attention to it. I just mentioned they dropped their numbers to 111,000 after the government report came in at 114,000. So it's probably not valid to say that ADP is more accurate. Plus the fact we're all talking about this 818,000. That'll get revised again. This happens every year. Bigger magnitude, and when you get turning points in the economy, you see bigger magnitudes of changes like this. So it's not a surprise to statisticians and economists, but I can see why Wall Street is a little concerned about it. Interesting thing in the ADP report, they're still saying manufacturing losing jobs, 8,000 jobs. They have been saying that for months, and it doesn't happen. So we'll see if that happens this time. Professional and business services, something that economists have been watching closely, down 16,000 in their survey. So these would sort of portend problems if we get the same numbers in the payrolls numbers.
Can you help us with just the framing of this? Because we threw around these numbers, 99,000. We're expecting tomorrow somewhere between 120 and 180,000 jobs added. This question of what it means to be good or what it means not. What is the appropriate number of jobs being created? And should it be actually significantly higher now than, say, 10 years ago or 6 years ago, given how much bigger the economy is?
Well, you make a valid point about the size of the economy. We've gone back and forth about what the level of job creation needed to absorb new entrants to the labor force is. The Fed's looked at somewhere around 100,000 or above, but that's not a number that Wall Street's going to find acceptable. And it becomes a matter of not what the level is, but the speed at which it has decelerated. That would scare the Fed. If we got 100,000 this week, Fed would say, you know, that's not a terrible report on a statistical basis, but because it happened so fast that we fell off, that suggests the economy is slowing faster than we thought and we need to do more.
I don't know how many market participants would come out and say that's not a bad report based on a statistical basis if we got 100K. tomorrow morning.
Well, if you put a bunch of economists in a room, they would tell you that because they're...
No, I have no doubt economists would say that.
We're nerdy people who...
Hold on a second, and I just have to respond to that. There are some people who say that it actually should be closer to 300,000 of jobs created, and that actually it was normal what we saw before just based on how much bigger the economy is. So we don't have a sense of what's tight and what's not. I think that's compelling.
If you go into a room of economists, you just walk out confused. Mike, thank you. Appreciate it.
I'm glad I was able to help.
99,000 is the number on ADP. The estimate was 145. Equities negative by 0.2. We're down 0.5 on the NASDAQ 100. I talked about that bid into the bond market. The 2 years down by 3 basis points now. The dollar is weaker. The yen's much stronger now, 143. We're on the brink of breaking that level. We are negative on that currency pair by 0.5%. Time now for some morning calls. First up, BMO Capital Markets downgrading Dollar Tree to market perform. The analyst saying the discount retailer's disappointing second quarter earnings report was the final straw. Was reading that note this morning, pointing out competitive issues. Not issues around the consumer, competitive issues, execution problems. That stock is down by another 1.7%. Next up, Barclays upgrading Nordstrom to equal weight. The analyst citing a proposed $3.8 billion deal by the Nordstrom family to take the department store chain private. That stock is up 1%. And finally, Wells Fargo upgrading Roku to equal weight. The analyst seeing potential in the company's Roku channel service and strong revenue growth ahead. We're positive there by a little more than 3%. Turning to U.S. Steel, Timna Tanners of Wolfe Research maintaining her outperform rating on the name. Back in August, Timna saying the best odds for a Nippon takeover approval were under a possible Harris administration, adding that Japanese ownership is the best option for the steel union as the company will likely shutter if the deal falls through. Timna's with us around the table for more. Good morning. Thanks for being with us. You wrote that ahead of the news in the last 24 hours. How have things changed for you? How has your base case shifted?
Look, there's no denying that if President Biden were to scuttle the deal, it's a done deal, right? That's hard to combat. It's very unusual, and so it wasn't really in our base case. But at the same time, first of all, it's not done until it's not over till it's over. I do think that this could be very aggressive negotiating tactics from the union, unprecedented perhaps. And I think that the alternative to the union is likely losing jobs. So I really don't understand the outcome here being staying with U.S. Steel.
Are we saying without a takeover, this might not be a viable business?
No, I'm not saying. I'm just saying that there are some assets that are union-owned that would be shuttered if this deal doesn't go through. They have other assets that they prefer, that they've invested in, and ignored the union a bit, which is part of their beef with them. But they would shut union jobs, I think, very clearly, be in the next several years if the deal doesn't go through.
You think there's a case to own U.S. Steel even if this deal doesn't go through? Can you explain why?
Yeah, absolutely. I think that, so much focus on the deal has gotten a different kind of investor in this space. But if you look at fundamentals and you say, even on our pretty challenged steel price outlook, and you look at the peers where they're trading at and give U.S. Steel a discount on our numbers, stock's 35 to 45. That's what we've been saying in our notes. And they're starting up new capacity that will allow them to actually outperform peers in terms of volumes. So that sets them up, I think, a bit differently. And then assuming they execute, which I think they will, again, it's really tough to see a lot of downside.
How do you make sense of just the timing logic of Nippon coming out with this deal at a time that was clearly politically fraught?
I don't think it was really clear. It was a year ago when they started this process that U.S. Steel did, and I think clearly the participants underestimated the politicization of this. I mean, if you look at the steel industry, I was thinking about this, it's 5% owned by Russians. There's quite a bit of foreign capacity over the years, and U.S. Steel did a very public process that was endorsed by all their, their board, et cetera. So I think everybody just underestimated how much this would get politicized, given that many of the states they operate in are, states that are toss-up in the election.
But why didn't they do more to get the union on board?
I'm not in the weeds on that, but I feel like they did a lot. Nippon came out earlier this week and said that they would commit to a sizable investment that U.S. Steel standalone certainly would not. So Nippon would keep those assets running, the union assets. I thought that was a pretty big statement. And the union, I feel like their protests have gotten milder and milder every time I see one of their missives. So I did think we were moving in the direction of perhaps getting it closer to finalization. So we'll see. But I think they tried, and maybe there was a cultural barrier.
We've talked so much about U.S. Steel and not enough about Nippon Steel. What does Nippon ultimately want in an asset? And if they don't get this one, where else are they looking?
Well, they'll be blocked from the U.S., right? That's for sure. I mean, Nippon Japan is a melting ice cube in terms of manufacturing capacity, right? And they've been losing blast furnaces over the year, principally because China is oversupplying the market. But they've also been losing their automotive business has all migrated, if you will, to the U.S. So they're just following their automotive customers. So that seemed like a natural transition. But again, I don't know, this national security argument is, I guess, in the way.
Can I pin you down on a base case now? Have you got one? Does this go through after the election?
I mean, if it goes through, it goes through after the election.
Right. 50-50 still?
I went above 50-50. I guess it seems like below 50-50. That's all I'm going to say for now.
Timna, thank you.
Thanks.
Appreciate it. It's a tough one. Timna Tanners of Wolf Research. How they're campaigning is one thing, how they govern might be another, and I think a lot of people wondering why Nippon Steel didn't just wait until after the U.S. election.
Although, as Timna said, and I think it's a really important point, they started this process a year ago. That's how long this stuff takes. And they didn't maybe consider the fact that it's a swing state, but what foreign company is coming into this country and saying, is it a swing state? I guess they should.
Isn't that what you pay people for?
I guess so. Yeah, they should have. It's
right?
purple. What are you thinking?
Yeah, exactly. Okay. If you're just joining us, welcome to the program. We'll get some jobless claims for you in about 5 minutes' time. We had the ADP report a little bit earlier this morning, about 10 minutes ago, in fact. It came in with a downside surprise. ADP lower than expected. Equity futures off the back of it. Bit of a delayed reaction here, but we've got one now. We're down 1/3% on the S&P, down by 0.7 on the NASDAQ. Just to check out the bond market, down by 3 or 4 basis points at the front end of the curve, 372. We've got 10s at about 373. So we've actually got a positive sloping yield curve, 2-year out to 10-year, of a basis point or two this morning.
Just to put this into perspective, 2-year yields back at the lowest that we've seen going back to September of 2022 as people price in the possibility of a bigger rate cut. ADP takes a while for people to realize they really do have to care about it. And that's what you're seeing right now in markets.
It's usually shaped by whether markets care and then other people follow.
Exactly.
You know, like, does ADP really matter?
Today it does.
The anxiety around the economic data in America continues to build. Jobless claims just around the corner. Let's see if they continue to put a lid on some of that anxiety. That number drops in just a moment. Jay Bryson of Wells Fargo joins us alongside Kathy Jones of Charles Schwab, both here to react. From New York, this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while
This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
So one down, two to go. ADP, downside surprise. Jobless claims coming out in just a moment. Then it's the ISM services later this morning. We came in at 99K on the ADP report, 145, the median estimate off the back of that. Futures a bit softer. Down 0.25% on the S&P. In the bond market, the rally continues after a pretty strong start to the month of September. Yields now down at the front end of the curve by 4 basis points at 371. To help set the tone for today, jobless claims. And Mike McKee, this is the right kind of downside surprise.
This is the right kind of downside surprise. Jobless claims fall 227,000 after 232,000, a revision upward of 1,000 last week. This is for the last week of August. Continuing claims at 1,838,000 after 1,860,000. So that falls as well. So overall, the jobless claims numbers are pretty good. I'm looking at the unadjusted data, and they went down. Jobless claims totaled 189,389 in the unadjusted data, which is a decrease of 3,300. So we are not seeing layoffs. And this gets back to yesterday, the Beige Book, where you saw over and over again in the Beige Book that Fed districts were reporting companies saying they were holding on to workers, but they're not filling jobs via attrition, and they're not filling jobs to expand. They're just kind of sitting with what they've got. And it looks like that's definitely the case here between ADP and jobs claims. Not letting people go, but they're not adding people either.
This market really just feels like it's so finely balanced right now, on a knife's edge. That number just dropped, and futures briefly turned positive on the S&P 500. And if you bring up the bond market at the front end of the curve, yields were a little bit higher going into ADP. ADP came out, downside surprise, bonds start to rally, yields drop by up to 4 basis points. This number drops. Yields start to unwind some of that move. We're down now only 2 basis points to 373. And this is why about 30 minutes ago we opened up this hour and we all said, this is how finely balanced things are going into payrolls. We are one bad print away from pricing in a string of 50 basis point rate cuts and one good print away from seemingly unwinding some of the moves over the last month or so.
And the lack of clarity in the economy is really just sort of unprecedented in many ways. I keep thinking about this, and Mike, I'd love your take on this. I keep thinking about what the difference is and how big the delta is between not hiring a lot of people and actually firing people. And it seems like even in the Beige Book, people aren't hiring people as so readily unless they're going to try to replace a role. How connected is that as a step to then laying people off in this sort of not linear trajectory, but very predictable trajectory?
Well, it's definitely a semi-predictable trajectory in the past in terms of when you go into recession. First thing you do is you cut back on workers' hours. So we'll be looking at that tomorrow to see if hours worked cuts back at all. You cut back on temporary workers, and we saw that in the ADP report today with professional and business services falling by 16,000 jobs. So those are signs that things could be happening. But everything has been so weird since the pandemic, which we keep saying and saying and saying. You've got people here wondering, are we normalizing because we had such a strong labor market, or are we going down and the Fed needs to take emergency steps to stop it? Throw in 2 other factors. One, it's September. And so the markets are primed for bad news, and every September the market goes down, and we're seeing that. They're looking for things to get upset about. And then you have the election, and there are people who are saying, we're waiting to see what happens with the election before we make any business spending plans. So with all that together, you can imagine sitting around the table at the Fed and trying to balance all that out.
It's tough.
Deciding what you're going to do.
Mike, we've said on this show, though, for months now, we've asked the following question. Are we seeing a welcome cooling or an unwelcome deterioration? And after Chairman Powell's speech, at least in the near term, I do wonder whether that's a distinction without a difference for them, because he has now come out and said, we don't welcome any cooling at all from here. So if you get any further signs of cooling, and arguably we're still seeing it, it's just setting them up for action, isn't it?
Well, it's going to be very interesting tomorrow because we have John Williams, who's vice chairman of the Open Market Committee, and we have Chris Waller, who's sort of the intellectual center of the economists on the Board of Governors, who are both speaking. We'll get their views after the jobs number comes out. Actually, Williams is speaking as the jobs number comes out, so I hope the folks at the Council on Foreign Relations have their Bloomberg on their phone, you know,
on one of those monitors
when
in front
it's
of
happening.
him.
Yeah, exactly, to ask him about it. But it's their last chance to send a signal because the blackout starts on Saturday. So if they are worried and they don't want the markets to overreact one way or another, they'll hopefully tell us.
You nailed it. We've all got it circled. Governor Waller, 11 a.m. Eastern time tomorrow morning.
I'm laughing because I'm thinking of John Williams with two speeches, one of them with big in red. Good jobs report.
Yeah,
Next
of course.
Bad jobs report.
Two edits.
Two edits. And it basically, he's looking at the Bloomberg. It's like, okay, all right, which one? And that's essentially maybe how we're going to get messaged.
You just get a marker pen and start scribbling out methodical and gradual. Just take out those two words, right?
Seriously.
Mike McKee, thank you. Appreciate it. If you've missed the last 15 minutes or so, 20 minutes, we had the wrong kind of downside surprise on ADP, 99 versus an estimate of 145K. We had the right kind of downside surprise on jobless claims. Jobless claims came in at 227. The median estimate was 230. I said earlier, if you walked into a room of economists, you'd walk back out confused. If you look at this data this morning, you're not getting clear. Is challenged with solving some of these issues. Jay, what is going on in the labor market in America?
Well, John, I mean, I think you kind of talked about it before. I mean, you know, what we're seeing is we're just not getting as much hiring as we had before, and I think that's consistent with the ADP number we got this morning. But we're also not seeing businesses laying people off, and that's consistent with the initial jobless claims number. So, you know, the labor market is has moved back into better balance, which is a good thing. Things are slowing down in the labor market, but, you know, and I think Lisa used this word earlier, you know, you're kind of on a knife edge right now, and, you know, you don't want things to deteriorate further from here.
Jay, what gives you confidence it won't? Is there any reason to be confident that things stabilize? That this isn't just a moment in time, it's an end state for the rest of this year?
So I think there's two things, John, that things kind of stabilize here, and you know, recession is not the base case call. One would be, if you look at the financial position of households, in general, it's pretty good. Yes, we have seen delinquencies go up on credit cards and on autos. We've seen, you know, we're hearing anecdotes of low-income consumers feeling some stress. But if you step back and you look at the debt situation, if you look at the debt service ratio of the business of consumers, it all remains pretty good. And the same thing applies to the business sector in general. Businesses in writ large don't really have to lay people off, you know, in aggregate right now. And so those, I think, are two good things to just take a deep breath. Things aren't falling apart out there, and, you know, a continued expansion is probably still the base case.
Jay, let's say the base rate right now is 100 basis points lower, and companies had an easier time borrowing at a more reasonable price. I guess, would you start to see a pickup in hiring based on the fact that companies are still hopeful, and frankly, the reason why they haven't been more aggressively hiring is in part because of uncertainty around the economy as well as the election?
You know, Lisa, I think that's part of it, but, you know, we're also seeing, when you look at the overall economy, you are seeing signs of softness, right? We all know that, you know, the housing market has been kind of soft for a while. We all know that manufacturing is also soft right now. The only real thing that's really holding up the economy right now is the service sector. And so, you know, when we get the ISM number at 10 o'clock, that will be important to tell us what's going on in there. And so, you know, as rates come down, the the point here is that should help to stimulate sort of things. I think there's some uncertainty, whether it's towards the election, whether it's towards the economic outlook in general. But in general, what we are seeing is monetary policy is in a restrictive stance right now. Rates do need to come down to help stimulate spending.
Jay, is this normal to have this level of uncertainty? The knife's edge that John was talking about, this idea that things could tip the scales one way or another. Is this always how it feels at tipping points that seem to last forever with such model data?
Yeah, there's always uncertainty out there, right? And if you go back, you look at the pandemic, right? That was a very fast-moving sort of situation. You look at the financial crisis, lots of uncertainty around there. Absent a major shock, and the last major shock was the pandemic a few years ago and the unwinding from that. Absent a major shock, I'm kind of hard-pressed to think of a time in the last, few business cycles when things have felt a little bit uncertain as they do right now. So I do think it's not normal right now, given where we are. But we're, unfortunately, just the nature of the way the economy works and the way the overall geopolitical situation works, there's always a base level of uncertainty.
You said earlier, not much hiring, not much firing. Sounds very Goldilocks. But we heard from Mike McKee was just talking about hours worked will be important. What kind of number of hours worked would you need to see to then get concerned that potentially the next point of call is going to be layoffs?
Yeah, so if we're seeing, aggregate hours worked tomorrow going down, let's call it 0.3% or something like that, then I'm starting to get a little bit concerned, at that point. And so I think Mike had a really good point there in terms of the hours worked. And, the first things that you do see is you see temporary workers start to go down. It's like 24 out of the last 26 months, we've seen the number of temporary workers going down. So we're already seeing that. And if we do start to see hours worked going down by that magnitude, 0.3%, 0.4%, then I'm really starting to get a little bit concerned.
Jay, thanks for the update, sir. Jay Bryson there of Wells Fargo. The team over at Wells Fargo looking for a half-decent jobs report. What is a half-decent jobs report tomorrow? Something in and around 150 is basically what we're hearing. Bank of America looking for a punchy 200K. Citi at the other end looking for 125. Bank of America looking for a 25 basis point cut in September. Citi looking for 50. There's a spread in the estimates for jobs there of about 75. And Lisa, that's about the size of the average reduction in the revision over the last 12 months. So the difference between 25 and 50 is about the size of the average revision over the previous year.
And it's also the difference between views that call for a soft landing, Bank of America, or potentially a more likely recession, which is Andrew Hollenhorst over at Citigroup. It highlights how disparate people's opinions are, not just of the headline number, but how you read that through to an economy that's still hanging in there, and whether that actually does kind of undermine this idea that everyone's betting on a soft landing.
The 2-year right now is not betting on that. It's betting on something worse potentially, at least in terms of the price action of the last 3 days. We're not even 3 full trading sessions into September stateside, and we've had a move of almost 20 basis points lower on a 2-year. Kathy Jones of Charles Schwab joins us now for more. Kathy, why do you believe, and welcome to the program, why do you believe that all roads lead to lower yields from here?
Well, I think the fundamentals just tell us that, John. We've had the weakness already in parts of the economy, manufacturing in particular, but also evidence of some slowdown in consumer spending. But also you have the whole global picture right now. So you've got weakness in China, translating into some weakness and softness in Europe, particularly in Germany in the manufacturing sector. Collapsing commodity prices, that's really been notable in the last couple of weeks. It's been notable for a while, but really seeing those industrial materials prices come down. And then you get to the U.S. where policy is restrictive. The Fed has already sort of pre-indicated that they're going to cut rates. What's going to send rates higher from here would be the question I would have. All roads seem to point to Fed easing, lower rates, and more disinversion of the yield curve.
Then if you extrapolate that out, Kathy, how much lower can they go if you really do see this as a more inflationary moment than pre-pandemic?
Yeah, I think the the terminal rate, nobody really knows where that is, right? Everybody's guessing, and that estimate's going to move around based on whether we hit a recession or whether we are able to pull off a soft landing. But we'd say the Fed funds rate at 3% is kind of a base case scenario for us. It doesn't give you as much room as you go out the curve for yields to fall in the Treasury market, but there's still a substantial distance between 5.5% and 3 or 3.25% in the Fed funds rate, which is where we think we're going.
We've been talking a lot about how credit markets have been very behaved, and they've been working in tandem, frankly, with stock markets in terms of continuing to gain, even though there are these concerns about a weakening labor market. At what point, at what data levels would you start to get concerned about credit quality at a time when perhaps there are a number of people talking about this being a little bit more pernicious than just a soft landing?
Yeah, I think we've been fairly cautious about credit, probably too cautious in this cycle about credit, wanting to stay up in credit quality because of the concern that we'll see some spread widening, and spreads have been so low. We are seeing some widening, say in high yield, triple Cs are greatly underperforming other parts of the high yield markets. You're seeing a little bit of dispersion there. In the investment grade market, I guess I would be concerned if we had a real solid recession indicator that came out, negative employment growth, that kind of thing. But this is, we've talked about this, Lisa, many times, this is a different cycle when it comes to credit. Borrowers have been able to refinance their debt if they need to. There's been plenty of money available to do that and term out the debt over a longer time period. So we're not looking for a big blowout in spreads, but we do favor staying up in credit quality.
Hey, Kathy, I just want to finish with the yield curve slowly normalizing. And as it normalizes, whether it's easier now to convince people to get out of cash, when you speak to the charge swap clients, what are they doing?
They have been moving out. We've been on this bandwagon for quite some time, fortunately. So those who have taken the leap, I think, are feeling pretty good about it. We're not favoring long duration at this stage of the game. I think just kind of missed enough of the move at the long end to suggest that's not a great idea, unless you're in a laddered strategy where you're just spreading out your maturities over time. But we still think there's opportunity and money to be made in the bond markets as yields come down. But a lot of clients have already kind of moved out the curve and taken that advice.
They're finally listening. Kathy, thank you. Appreciate the update. Kathy Jones there, Charles Schwab, going into payrolls tomorrow morning. Before we talk more about the jobs data and a week ahead, let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Verizon says it will buy Frontier Communications for $38.50 per share. It's a $20 billion deal with a 37% premium to Tuesday's close. Frontier bills itself as the largest pure-play fiber internet company in the U.S., so that combination would help Verizon offer high-speed internet more widely. Demand for data usage is only expected to grow, which has been forcing telecom providers to bulk up their offerings. And the Wall Street Journal reporting that Donald Trump plans to adopt Elon Musk's proposal for a government efficiency commission. The Journal cited portions it viewed of Trump's speech that he plans to give to the Economic Club of New York today. Trump will reportedly outline a suite of economic proposals, taking a more aggressive swipe at regulations and pledging to rescind certain unspent funds appropriated during the Biden administration. The Journal reported that he will also double down on his embrace of crypto, removal of hurdles for new drilling, and broad tariffs. And taking place later today at our headquarters in New York City, Bloomberg Power Players, where we gather industry leaders, investors, and athletes revolutionizing the business of sports. You can catch conversations with names like Cal Ripken Jr., Women's Soccer Commissioner Jessica Berman, Steph Curry, and a live taping of the deal with Jason Kelly and A-Rod. Tune in to Live Go on the Bloomberg terminal, or you can stream it on Bloomberg.com. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, setting you up for the rest of the week, looking ahead to payrolls and looking ahead to earnings from Broadcom. We'll catch up with Mark Lipotsis of Evercore ISI.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back. right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Equities on the S&P 500 just a little bit softer as we count you down to the opening bell, about 40 minutes away. Here's the trading diary in the calendar for the rest of this week. ISM services coming at 10 a.m. Eastern time tomorrow. Fed speak from Williams and Waller. It's going to be big, particularly Waller at 11 a.m. Eastern time. And then it's the main event as well, payrolls tomorrow morning. As traders await more jobs data, Broadcom reporting after the closing bell today. Mark Lipacis of Evercore ISI joining us now for more. Staying bullish on the chip maker as it ramps up AI revenue streams. Mark, thank you very much for being with us, sir. I just want to talk about some of the pain more broadly in the chip sector over the last few weeks. What do you think's behind that, and are you willing to lean into some of it?
Yeah, so normally what happens during a semiconductor upcycle is typically every cycle over the last 15 years, you see a mid-cycle correction. And typically this happens when the industry revenues kind of hit a year-on-year revenue growth peak. So you continue to have revenue growth, but it is at a decelerating rate. And because semis are a momentum group, what you see is typically a lot of momentum investors use that year-on-year peak to get out of the group. Historically, if you look at what happens after a mid-cycle correction, the group bottoms, it bounces, we kind of have a period of volatility, which is where we are right now. And then the group typically outperforms on average by about 20% over the next 6 months. So there's still growth, and we like the group here. And generally speaking, we want to be buying the group.
Buying the group, what about specific players that have performed in a disproportionate way? And I'm thinking of NVIDIA at a time where maybe some of the other players can play catch up, but NVIDIA is now facing, too big monopolistic types of accusations, as well as sort of a lack of proof cases in terms of how it's being used.
Well, what's interesting is if you look back in time, we always viewed computing as being the big driver of consumption of semiconductors. And over the last 60, 70, 80 years, what you notice is that there's a new computing era every 15 to 20 years. So these computing eras typically last 15 to 20 years. And in the beginning of every computing era, the use cases are often questionable, and they're hard to imagine, like the PC in the 80s before word processing and spreadsheets came out, like cell phones, when the iPhone came out in 2007. We didn't really understand that we were going to have YouTube and Waze and Uber and Lyft and all these really worthwhile applications. So we think it's actually normal for the initial use cases to not be as exciting. But if you look at what happened this earnings season, you have some of the most important companies of the world talk about how AI is generating a return. Amazon talked about how AI saved them 4,500 developer years of work. Google said that AI generated billions of revenues for them. Walmart said, they generated, 850 million pieces of data for their catalog, and they were able to do that with 100 times less people. So we think the use cases and the return is there. It just hasn't kind of come through to the consumer. So if a consumer uses ChatGPT, they say, hey, we can use that to write a poem. Is that useful? But the big companies who are spending the money are finding return.
Mark, we're talking about this at a time of real economic uncertainty, and that's really where I want to go with you. How independent is the semiconductor cycle from the economic cycle?
Yeah, that's a great question. The thing about the semiconductor cycle is that semis are in the beginning of the supply chain, and the consumers are all the way at the end. And in between, there's distributors, contract manufacturers, OEMs, OEM distributors. And historically, what you've seen is when semiconductor lead times increase, everybody builds inventories, and semi revenues go up 30, 40%. And then when their lead times shrink, which is what had happened over the last year or so, everybody shrinks their their inventories. And so the semiconductor revenues show negative growth, right? So we believe we're at the bottom of an inventory correction, and actually we're in about an upcycle. So in small, more nominal economic times where, maybe the GDP is only -1 or something like that, you see the semiconductor cycle actually trumping the economic cycle. Now, if you have a great recession and GDP is -8%, then that's then the semis can't work. But we think we're at the bottom of the inventory correction, and that the restocking cycle will start to take over.
Mark, we're also in an election cycle, and this is an industry that is very sensitive to geopolitical concerns and political concerns. Dan Ives yesterday saying this is political agita when you look at a name like NVIDIA. Who's better for this sector, Trump or Harris?
Well, I think that, what we have observed is that, the geopolitical policies seem to be quite similar between the administrations. And this is one area when you think about like the CHIPS Act, for example, where you have bipartisan support. So we think that it doesn't really matter which administration gets into office. We think that there may be nuances in second or third order impacts, but by and large, we think that the industry has the support of both administrations, and so we're positive about the industry.
Mark, a clinic. Thank you, sir, for coming on. We've got to do this again soon. Mark the Potts is there of Evercore ISI. Tomorrow is going to be a single-issue program. It's the payrolls report, and here's the lineup. Jay Poloski of TPW, Priya Misra of JP Morgan, Mike Collins of PGIM Fixed Income, Torsten Slok of Apollo. The guesses. Can we call them the guesses? I think we can. The estimate, the median estimate in our survey, 165K, the previous number 114. Looking for the unemployment rate to drop back to 4.2 from 4.3. The number tomorrow morning. We'll see you then. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China, all of that is in our interest. And whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, market reaction kind of blunted after a little bit of a disappointment on ADP. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, investors are weighing mixed readings on the labor market ahead of tomorrow's highly anticipated jobs report.
As NVIDIA's wipeout fuels concerns, the AI trade gets another test. Broadcom is reporting after the bell today.
Plus, from Verizon's broadband push to U.S. Steel drama, we've got a roundup of today's deals action. So all that and more coming up. Let's take a look at where markets stand 30 minutes until the bells ring. Pretty interesting trade here, even though we're not talking about big movements. The S&P 500 down about 0.1% after that weak ADP print, initially dropping to session lows in the pre-market, now coming up a little bit. The NASDAQ 100, though, your big tech under more pressure here, down about 0.4%. A little bit of movement in the bond market, a little bit of a rally, Matt Miller. You take a look at the 10-year yield, currently lower by about 2 basis points.
Yeah, Chanel's watching that to get down to 370 and break. Take a look at this chart. In the blue, you'll see economic surprises, and they have been softer. ADP was soft today. I guess you could say that initial jobless claims was a little bit stronger, but really bang in line. Nonetheless, we continue to see an upward trend in stocks with those soft economics as investors hope for rate cuts from the Fed.
I literally screamed at my desk after that ADP's report. But let's watch some pre-market movers before we talk about the macro here, because single name news for sure. Verizon agreed to buy rival telecom company Frontier for about $9.6 billion in cash, which is a 37% premium to Frontier's closing price on Tuesday. But you still have Verizon on the heels of that deal, now down about 0.2% pre-market. You also have C3 AI plunging after its earnings disappointed Wall Street. And you have C3 AI down almost 20%. Broadcom down 1.5% ahead of its earnings after the bell. We are going to talk more about that AI trade in a moment.
All right, let's take a look at the economic data that we are all so keenly watching. We had the jobs report from ADP, and in normal times we don't really give it a lot of time. However, this morning there was a little bit of a disappointment, and initially markets dropped.
Initially, futures. And now we're kind of back to where we started. It's interesting if you take a look at the movement around Fed cut pricing. We're about 50-50 as it comes to a 25 or a 50 basis point cut coming in the next couple of weeks.
we're still there. So this didn't really move the needle, but it did raise the stakes for what we're going to hear tomorrow.
After that ADP data, the reason I screamed is we watched the 2-year barrel right down to just near 370. It popped right back up just a little bit. But Matt makes the point. Since we started this show, you have the 2-year down a full percentage point since middle of summer, Katie.
All right, let's get a little bit more into the weeds here. Michael McKee, Bloomberg Chief International Economics and Policy Correspondent, joins us now. And, you know, we're processing every piece of data that comes across EcoGo, obviously counting down to the big daddy tomorrow, the non-farm payrolls number. What was your take on the labor market with what we saw today?
Well, we're seeing what I talked about on Tuesday, that everything that we get feeds into the narrative that people will try to explain tomorrow at 8:35 when the numbers are out. It's all about that. And the ADP report, as you mentioned, doesn't always give us a clean read. The jobless claims numbers should tell us something about whether we're seeing layoffs, and we did not. If you take a look at what happened with initial jobless claims, we get 227,000. It was 232 the week before. This is the lowest number in the summer. And the white line there is the non-seasonally adjusted number, and you can see how it has fallen tremendously, and that suggests no layoffs. Now, those red boxes are around July every year. This is what happens. We get this dispersion between the two things. We get a jump in the jobless claims numbers for the seasonally adjusted, and non-seasonally adjusted go down because of layoffs. So we don't get a reading on this that really tells us a lot about where the economy is going, other than it's not in crisis. Then you take a look at the ADP numbers, and I did not scream like Shanali, but they did get my attention. My eyelids rose, I guess. You look at the ECAN function on the Bloomberg, and you can see here what happened, and what the Fed may be concerned about is the orange boxes are service industry jobs, and you can see the trend just going down, down, down. This is the weakest service industry numbers in about a year. So if service industries are not hiring anymore, then that could be a problem, because they are the biggest drivers of hiring, and that's what we saw. Now, ADP has been forecasting manufacturing job losses for some time that haven't occurred, and we did see that again today, them saying 8,000 jobs lost. But it's the professional and business services that will catch people's attention, because you do start laying off temporary employees if you think you're going into a recession, and that was down by 16,000 in their number. Information services down by 4,000. So some categories that could be problematic tomorrow to keep an eye on out of ADP, whether or not they prove accurate in the actual level of jobs created.
All right, Mike McKee, we will see you 24 hours from right now as we parse through what Matt Miller says is the big daddy jobs report. Let's bring in Lisa Shallot now. She is CIO over at Morgan Stanley Wealth Management. And Lisa, you take a look at the market reaction to this ADP print we got. Of course, initial jobless claims coming through as well. At this point, I don't know what would be good news for the market at 8:30 a.m. tomorrow. What would be the best possible print to actually maybe breathe some life back into the bull market?
So I do think that you know, it's hard to know what is going to please this market. To your point, we have, you know, half the folks, you know, looking for a weak number that pushes Chair Powell to go 50, and you know, the expectation is that that's the good news. Alternatively, you have half the folks saying, look, if we're really going to get a soft landing, that means a slow Fed and a stable labor market where consumption holds up. So look, we're in the soft landing camp. We're looking for a solid jobs creation number. You know, hopefully we come in right at the consensus, and that means a market that starts to broaden, right, and suggest a Fed that is going to be measured and go somewhat slowly. That may not be great, you know, for some of the, you know, the tech high flyers, which have started to swoon a little bit. But it should be, you know, decent news for, you know, the core of the market in financials, industrials, and energy stocks, for example, that should do well if we get this slow and steady, moderate soft landing.
Lisa, what about a slow and steady rate cutting cycle? At the end of the day, there are a lot of doubts that are hanging around that a 25 basis point cut, or even 2, or even 3 for that matter, in the next, let's say, 3 to 6 months, would make much of a dent in then moving some of these consumption numbers forward, given the weaknesses you're already seeing in the labor market. How much do rates need to go down to really stimulate the economy?
Yeah, so this is, I think, one of the biggest controversies because, you know, this has been an economy where higher rates have had an impact, or the rate-sensitive parts of the economy have been much smaller than historically and very concentrated. And so the question of whether a slow and steady Fed or a soft landing Fed is going to help housing, whether it's going to help small businesses, whether it's going to help the low-end consumer, whether it's going to help commercial real estate, I think the jury's out on that. And what that might mean is if we get a soft landing, we have a mix in the market that's very similar to what we've had over the last couple of years, and small caps don't catch up, and we don't see a big cyclical trade, if you will.
So it is the small caps, it is the cyclicals that you expect to react most favorably to rate cuts. I was going to ask, you know, in terms of industry groups, you know, which sectors do you want to be long if you say you had a crystal ball and you knew they were going to cut 50 basis points?
Yeah, I think you know, kind of the bigger the Fed goes early, the better that's going to be for recharging, you know, the more cyclical, more small cap, more rate sensitive pieces of the market. Again, you know, our view is that the Fed's probably going to be slow and deliberate, and that may be painful for some of the folks, you know, who are looking to employ the traditional quote unquote rate cut playbook.
And Lisa, with your role as Chief Investment Officer, I'd like to get your cross-asset view right now, because especially earlier in this week, we were worried about that yen carry trade unwind again. That was used to maybe explain some of the jitters that we were seeing, especially in some of the big cap tech stocks. How much weight do you put in that argument? I mean, is this a real force in this market, or are we perhaps using this as a scapegoat?
No, we believe that it has been large and it is a real force. It's more of a technical positioning force, but it is not, that trade is not fully unwound. And so I do think that this is going to be a lingering pressure until we get more clarity on the pace from the Fed. And so it is a risk that is out there, and that risk probably contributes to volatility and you know, plays out in terms of vulnerability for some of the most richly valued parts of the market, which, as we know, has been in tech.
Lisa, you know, there has been a lot of conversation about concentration in this rally into those large cap tech names for the majority of this year, much of last year as well, from what I remember. So on the way down, what does that look like? If the concentration has been loaded into those names, then is there a risk that those names can see a bigger drawdown?
Absolutely, right? These trends tend to cut both ways. And so one of the things that we've talked a lot about with our clients is the value at this point in the cycle of potentially moving away from that market cap weighted index, where those concentration dynamics have been so profound, moving more to an equal weighted index to mute what could be a little bit of an outside sensitivity on the way down.
Lisa, great having you on the program. Thank you so much for joining us. Lisa Shallot there, Morgan Stanley Wealth Management Chief Investment Officer. Quick check on futures as we head to break. We are looking at unchanged S&P futures, but that masks the volatility that we saw this morning when the ADP jobs number came out. We saw a big drop and then a recovery after the initial jobless claims. NASDAQ futures still off almost 1/3 of 1%. Russell 2,000 futures up. Let's get a look at some of the stocks moving ahead of the opening bell. For that, we go over to Abigail Doolittle. Abby?
Well, let's start off with the stock that's really tumbling here in the pre-open, pre-market. That is C3AI, down about 20%. Now, there's a big bearish short interest on this stock, but what happened here was, despite the fact that there was overall revenue growth, it was due to services, not software. Software subscriptions came in light, and therefore this big move lower. But again, lots of bears already on that stock. Now, speaking of AI, if we take a look at the shares of Hewlett-Packard Enterprise, we're going to see that they're down 5.4%. The AI contribution to the quarter that they just reported, it was strong, but it was offset by margins due to weak server business. Therefore, investors right now selling that stock down 5.4%. Intel is also lower. This as we have the Airstate Group cutting it to a sell. This is one of 6 sells. There's 37 neutrals, and then there are 7 buys. Overall, this stock down 60% on the year coming into today, having to do with the company having a hard time getting things out of neutral, I would say, and really turned around. Let's end on a break.
37 neutrals?
Yes, 37 neutrals.
Go ahead and say sell. Are they afraid they're going to hurt somebody's feelings?
Then what's the point of covering the stock?
They're not quite brave enough, and maybe some banking relationships that they're hoping that there could be, and then, you know, who knows, maybe the rating gets boosted to a buy. And then a real bright spot to end, and I'm interested for your thoughts on this, Matt. Tesla up 2.7%. They are, of course, launching an advanced driver assistance program in China and Europe in the first quarter of next year if it gets approved. And then there's also a story out that they are about to provide winter tires for the new Cybertruck. I will say I saw one in Westchester the other day, Matt. Was that you?
No, I have not yet driven a Cybertruck.
I love the Cybertruck.
You have to get one with winter tires.
I find them to be heinous, but I admire the company for going ahead with it. Like no other company in the world would make that thing.
I need a Cybertruck podcast from Matt and Hannah.
Hannah drove it, and tune into my podcast, Hot Pursuit, with Hannah Elliott. You can find it on Apple Podcasts or wherever you get your podcasts. Abigail Doolittle, thanks very much for that. Coming up, skepticism rising about the AI trade on Wall Street. We're going to go over to the left coast and talk to Ed Ludlow, co-host of Bloomberg Technology. Broadcom's coming out with earnings. That could be a reset. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
get to high interest to look at what's making headlines around the world. French President Emmanuel Macron picked Michel Barnier as the country's new prime minister. The decision follows months of political uncertainty in France after a snap election didn't deliver a majority for any group. Barnier now faces the challenge of forming a new government in a very mixed political landscape. And Samsonite has selected JP Morgan and Morgan Stanley for its dual listing in the U.S. The luggage maker is looking to improve its liquidity and draw more investment globally. Other banks are also looking to join the lineup. Samsonite, which currently trades in Hong Kong, may make the U.S. its primary of the two listings. Plus, actor Matt Damon and Lin-Manuel Miranda, the creator of the hit Broadway musical Hamilton and like a million other super successful projects, will appear at a campaign fundraiser for Vice President Kamala Harris in New York City this month. Tickets for the dinner are going for $25,000 a head. The Harris campaign has been leaning on celebrities such as Anna Wintour and Oprah Winfrey as she looks to expand her cash advantage over the Trump campaign. Shonali?
And we're going to check in, Matt, now on AI stocks, because today, after the bell, we get Broadcom earnings with a focus on its full-year guidance. Meanwhile, C3 AI is plunging after reporting quarterly subscription revenue that missed estimates, and it's down more than 18, almost 19% pre-market. NVIDIA is holding steady after a whirlwind week after news of an antitrust investigation and concerns around its valuation. Let's discuss it all with Bloomberg Technology co-host Ed Ludlow, and perhaps we start with Broadcom for no other real reason than it's like the next catalyst here for this market. We were kind of pointing out yesterday that over the month, you really had almost every stock in the Philadelphia Semiconductor Index down over the month. Where's the sentiment headed into Broadcom?
Yeah, with Broadcom, there's a lot of hope. It is a big chip maker that's making headway in the market for AI-related data center gear. You know, NVIDIA dominates the market for AI accelerators or the GPUs, but Broadcom basically has two parts to its business, chips and software. And within the chips division, it's kind of a split in two. One where it provides really important gear for data centers, largely for data center networking. But it also has a custom silicon business. For example, it works with Google on Google's TPU. And there's an expectation it will upgrade or up its forecast for AI-related sales, and a part of that is whether it onboards other customers for which it works with them on custom AI-related silicon or ASICs.
Well, Ed, that's what I was going to ask. What is going to be the focus of this print? Because you mentioned, of course, that SalesView, they could upgrade it. Of course, they onboarded their third customer. There's, speculation that a fourth could soon be imminent. I mean, is that really what people are going to be paying attention to tonight?
Yeah, a new custom chip customer is sort of the idiosyncratic thing that the market will get excited about with Broadcom, but any sort of refresh or boost to its commentary on AI-related sales is kind of the story still, right? Is the investment cycle in AI intact? And again, if data centers are getting built specifically for AI-related compute, logically Broadcom would have a part of that. So there is a bigger picture signal that we can take if there's a strong print.
We've really seen the premium of all these big mega caps tech stocks, Ed, come back down closer to like an equal weighted S&P. Do the investors that you speak with out on the West Coast just have a little bit less enthusiasm as earnings from these companies, still very strong, slows down to sort of catch down with the rest of the group?
Don't know that they're losing enthusiasm. I think the line that gets repeated over and over, particularly those that hold significant volume of NVIDIA shares, is we are long-term investors. And they look at the life cycle of a data center, the dollars it takes to build a new data center or update one, how long it takes, and the new generations of technology coming online. And they basically say, we believe that the long-term story is intact, but we note in the short-term volatility because of the news headlines.
Speaking of the news headlines, and when we think about NVIDIA this week in particular, of course, a lot of sour sentiment around the stock for a few reasons. But then you have this headline as well about NVIDIA and other investors looking to back Applied Digital. And I'm interested in this because it's not just NVIDIA, it's also reportedly related companies. So other private investors really getting in on the boom as they said they would, but now in conjunction with NVIDIA. How significant is something like this? We've seen more of it.
Yeah, I mean, one thing I would say is that you see a lot of traditional venture or private growth equity names muscled out of the market because the mega caps themselves have on their balance sheet R&D spend, which is significant, or they have venture arms that push people out of rounds. There's a lot of focus, though, right now, for example, on NVIDIA and the investments it's making in private companies along the way as part of its strategy to do more than just make GPUs.
All right, Bloomberg Technologies' Ed Ludlow, thank you for that. And it's a busy day for Ed and Caroline Hyde. You can catch their interviews with the CEO of C3 AI, as well as the CEO of Verizon, following the company's takeover of Frontier Communications. That's coming up at 11 a.m. Eastern on Bloomberg Technology. But coming up on this program, Delta Stumble is giving JetBlue new wings. Details in Social Climbers coming up next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Topgolf Callaway announcing a plan to spin off into two separate companies, Callaway Golf and Topgolf. The move would unwind a 4-year tie-up between the golf club maker and the driving range operation. Next up, ChargePoint, the company that operates the largest EV charging network in the U.S., says it plans to cut about 15% of its workforce after missing revenue forecasts. Last year at this time, remember, the company laid off 168 employees, or 10% of its workforce at the time. And finally, JetBlue riding a tailwind from Delta's tech troubles. The carrier is raising its sales forecast for the quarter, saying it benefited from rebooking passengers from rival airlines whose flights were disrupted by a technology outage in July. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, quick check on futures here. We are 4 minutes until the opening bell, looking at unchanged S&P futures and NASDAQ futures that are down about 1/3 of 1%. That masks some pretty big moves. Shanali was just talking about Applied Digital involved in a $160 million private placement priced at the market, and those shares in the pre-market. Did I see it wrong, or are they up 52%?
They're up 52%, and that really wipes out all of its losses for the year. This was a stock that was down almost 52% this year.
That's Applied Materials. We're talking about Applied Digital.
Correct.
So APLD is the ticker.
Just imagine a green arrow.
A much bigger green arrow. It's a penny stock too, though, to be fair. All right, coming up, we're going to talk with RBC's Lori Calvasina. This is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. 20 seconds to go. And in terms of futures right now, not a lot of movement on the S&P, basically completely unchanged. NASDAQ futures are down and Russell 2000 futures are up. But there has been a lot of volatility this morning. When you had the ADP number come out and showing a weaker labor market, we had a real dip in futures. Then we had initial jobless claims come out bang in line, and we came back up. We're still about 120 points away on the S&P 500 from an all-time record, but it's only 120 points, right? We're at 55.20 or thereabouts. Get over to Katie Greifeld right now. She can give you the exact numbers in the first minute of trading. Katie?
Yeah, and there's not too much movement on the screen beside me. You can see, of course, the S&P 500 just about flat. That in and of itself is interesting, though. You think about all the economic data that we've gotten this week. Of course, that huge down day that we got on Tuesday to start off September. And right now, maybe taking a little bit of a breather. A slightly different story if you take a look at the NASDAQ 100, currently off by about 0.3%. Of course, big tech has been your big loser this week, and that holds this morning as well. And if you're looking for a bright spot, you're going to find a really small one in the small caps. The Russell 2000 index currently up about 0.2%. Now, some stocks to keep an eye on this morning. Let's start with Verizon, agreeing to buy rival telecom company Frontier for about $9.6 billion in cash, really looking to improve its high-speed internet offerings. Now, this deal, it represents a 37% premium to Frontier's closing price on Tuesday. What's interesting, though, you look at both stocks pre-market, both are down. Frontier even more so. Not usually what you see from the company being acquired, Shonali.
You sure don't. I want to talk about another deal here because you are seeing an opposite reaction. Applied Digital shares just surging after the company said that it had raised $160 million in funding from investors, including NVIDIA. Applied Digital is up more than 41% as the market opens. Remember, this is a stock that before today was down almost 52%, and the market cap heading into today was only 500 million or so. So 160 million goes a long way. Matt.
Yeah, absolutely. Worth now about $700 million in market cap. I shouldn't have said it was a penny stock, but you know, it's a small cap, we'll say for sure. Checking in on shares of the exact opposite of that, NVIDIA this morning. That company grappling with growth concerns and an antitrust probe here in the U.S. Do we call it a subpoena? Do we not call it a subpoena? I guess it really doesn't matter because the shares are trading for $105. Take a closer look at the AI trade with Bloomberg's Abigail Doolittle. Abby?
Yeah, Matt, I think we ignore the subpoena, whether it's a subpoena or not. That's not the real story here, at least to the best of my ability to determine. It really has to do with the fact that this stock was up so much earlier this year on those blowout numbers that they had put up for quarter after quarter. But last week, it was a good quarter, but it wasn't a blowout quarter or a blowout guide. So over the last 6 days, you can see shares down about 18%. This is the worst stretch for NVIDIA going back to September of 2022. I would argue more of this has to do with too far, too fast investors getting out in front of their skis without knowing that those blowouts would continue and that they would soften a little bit in the quarter that was just reported. Plus, sequentially, even though the numbers are massive growth on a year-over-year basis, sequentially, they're down more than 50%, or at least that's what was just reported. When we put this together with the chart, there's a bit of a startling picture here. Now, this is an interesting chart, lots of color on it, but you can see the big uptrend out of the October 2023 lows. This is that range we've been watching. It made it to the top. Now we're going likely to the bottom, which is below 100. The importance of a range, though, is not the range itself. It's which way it breaks. The fact that this range is breaking the uptrend as shown in these waves suggests that we're very likely going to hit down to the third wave around 70, or possibly the entire area, if it were to break to the downside, would take us right back to the 2023 lows, which is around 40. This chart suggests that there could be some real bearish action ahead for NVIDIA. We don't know that, but that is the suggestion. It's been pretty good up until now. But, you know, a piece of it, Katie, of course, I was talking about that too far, too fast. NVIDIA, even with this decline over the last 6 days, still a double on the year. And then take a look at the overall chip and AI space. Very, very strong year to date.
Yeah, of course. It's important to remember that we've come very far so far this year, even though the last month or so has felt pretty ugly. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with RBC Capital Markets Head of U.S. Equity Strategy, Lori Calvasina, joining us at the desk. Lori, great to see you again.
Great to see you. Thanks for having me.
So I don't need to tell you that it's been a pretty bruising start to September,
Yes.
I think is fair to say. You think about this market really on tenterhooks when it comes to growth scares. And then you look ahead, of course, to tomorrow's jobs report. I'll ask you the same question I asked to our 9 a.m. guests, and that's, what do the bulls actually want to see at 8:30 a.m. Eastern tomorrow?
So look, I think that, you know, there's a debate over where the unemployment rate is going to go. Even at RBC, our data science team thinks it's going to go to 4.3. Our economists think it's going to go to 4.2. So, you know, there's a real debate on, you know, kind of how much it's going to go up, right? And I think that the bulls really want it to go up enough to keep those Fed cuts on the table, but probably just want consensus to be met at this point, right? I think all along, part of the Fed cutting thesis was we need to soften the labor market a little bit to get some of those inflationary pressures off. Well, be careful what you wish for. We've got it, and now we're worrying it's going to go a little too far in the other direction. But I think just really threading that needle is what the street wants to see.
We are focused on stocks right now. Obviously, we just had the open, but I want to get your economic perspective on what a rate cut really does for this economy. I mean, even if it's 50 basis points, does that change the housing picture? Does that impact car buyers?
Look, I do think that you have seen recently just a lot of weakness percolating in that auto segment in particular. We heard about this back in May at the RBC Consumer Conference, and you were starting to hear it around the same time in company earnings reports. So it does seem like that's suddenly come on, and something about sort of where we've been in the very, very recent past has kind of hit a tipping point there. So maybe you could get some improvement there. You know, I know our data science team, they have some different data points they monitor on housing, and they do see when interest rates come down just a little bit that you do see sort of a spike in searches. So, you know, it could help, you know, I would say in terms of sentiment at the margin. But I think you're right. I mean, we are sitting here at a very high level of rates. It's going to take them time to get down. It's going to take time for that to feed into the economy. But I do go back to the idea that while this economy is clearly softening, you know, we're hitting some potholes here and there, it does seem to be pretty solid under the surface. So I do think we have some time.
Lori, what does a landing look like? And is employment really the only way to look at it? We stand here today and that 210 curve has lost its inversion. It is disinverted. We have met that moment, but what's the road ahead looking like?
So I would say, you know, if I'm just sort of I know people have put out their different definitions of soft landing on GDP and other things like that. I mean, I would like to see it stay above 2%. I think that, you know, 0 to 2% is typically a weak environment for equity markets. So from my seat, I really need it to sort of stay above 2. To have the market below believe that we're not on the precipice of a recession. I'm also looking at consumer confidence really closely, and specifically the Michigan Sentiment Survey. There has been a really weird positive correlation between year-over-year trends in S&P 5 and Russell 2000, and then just that Michigan sentiment data since 2021. We are in oddly just this, and the correlations are like in the high 80s, low 90s. It's really weird. It's unusual. It's not something we saw pre-COVID. And it just tells me the market is so much more sentiment driven. And if you think back to 2022, we saw sentiment plunge to recession type lows, and that took the market down with recession type pricing. So I think it's not just about the GDP data. It's not just about interest rates. It's also, frankly, about how people feel.
Well, that kind of brings us back to, again, what does this market want to see? It is a very sentiment-driven market. We're past, the bulk of earnings season. Now it's just the macro environment, and this is a Fed that's trying to cut rates here, and the point has been made. I think it was Mike Wilson over at Morgan Stanley saying that a 50 basis point cut probably would spook markets at this point, and we're really pricing in it's like a razor's edge.
And look, I do think you can sort of make the argument, if I take the counter right of my own view, right, because I agree with you and Mike. Like, I think that 50 basis points spooks people. I started in the business in 2000. We get these big chunky cuts or surprise cuts. It's not good. It's for a bad reason, right? You can go back prior to my experience. You can go back in past cycles and find examples of bigger cuts. I don't think that's really the market's muscle memory here. I do think that, we're just living and breathing every single employment print the same way we were breathing every inflation print, 6-9 months ago. I think that a lot of people I talk to in my seat, right, equity PMs, they're listening to what companies are saying. And apologies to the beige book, but they're not really reading the beige book, right? Like we're
not there yet.
Right. I was really puzzled by the reaction to that yesterday. But at any rate, they're looking at companies, public companies, and what they're saying, and we're not seeing public companies talking about layoffs right now. They are slowing hiring, but we're in this weird era where they have found all these other ways through technology, automation, maybe one day AI, it's not quite here yet, but to cut costs and maintain margins. That is very different in the post-COVID era. We've been really seeing that since kind of 2016, 2018. They can use all these technological tools to cut costs before they cut labor. But if we start to see companies go there, I think that is going to really concern the market.
Trying to wrap my head around, there's so much pessimism on the economy, right? And yet we have growth at 3%. Unemployment is 4.3%, so higher than it was, but still much lower than the historical average, right? Which I think is like 5.6. And if we get a good print tomorrow and we're back at 4.1%, I mean, it's not all about cutting costs, boosting margins. Sales in the last earnings season were 5+%.
Yeah. No, I think underlying the surface, right, I think things are still very solid. And there was one retail company that said in the last couple of weeks, I was out in late August, so I was kind of playing catch up on earnings the other day, but there was one company that just said very plainly, we still see the appetite to spend. We still see that willingness to spend, right? People are fed up with inflation. They're looking for value. They're more selective. They're more choiceful. I'm in that camp too. I have little kids. I mean, we're buying back to school stuff and I'm looking for the cheap shoes, so I get it. But the reality is that while the jobs are still there, that spending power is still there. This is weird psychology we're dealing with post-COVID, and I do think that at the end of the day, while the jobs are there, we're going to muddle through, and that's why we are all breathing in that data so closely.
Weird psychology. We're going to talk about weird market moves next. Lori, stick with us. Coming up next.
We're going to get weird today, huh?
I'm all about the weirdness. Stick with us. Coming up, BMO says disappointing earnings from the Dollar Tree was the last straw. Details on that next in today's Top Calls. This is Bloomberg.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea. But ultimately, you still have to do a lot of it. To just give you very superficial ideas, but at the end, you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when the designer doing is the spirit, is the heart that the computer don't have.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, BMO says that Dollar Tree no longer a buy. The firm says that the discount retailer's bleak earnings report was the, quote, final straw, and says that there's growing risk that its valuation could fall further. Next up, Wells Fargo says that Roku no longer a sell, upgrading the streaming video platform to equal weight, also raising its price target, citing the potential in the company's Roku channel service. And finally, RBC giving KB Home a sell rating. The analyst sees more near-term challenges for the home builder thanks to softer macro data in the housing sector. Shonali.
And we're back with RBC Capital Markets Head of U.S. Equity Strategy, Lori Calvasina. And it's interesting because you have the Philadelphia Semiconductor Index, which has NVIDIA in it, of course, just flying most of this year. But as we started September, actually every single stock is in the red. It's absolutely incredible. You have every stock at least down 4% or more, the whole index down almost 8%, and Intel being the laggard with a more than 11% drop. What is this? Is this a change in sentiment or a valuation reset? And if it's the latter, how far can this redness go?
I think it's both. So we have these industry models that we look at. It's across the market cap spectrum. We look at the Russell 3000, but we look at the rate of upward revisions for the broader semi group, and then we also look at the median PE relative to the broader market. And what's interesting is that if you take the tech sector, the semi and semi-equipment group is the only one that's in the red on the grid. And what I mean by that is you've got both negative revisions and you've still got expensive valuations despite the pain that we've already seen. So we updated this, I think, on Tuesday for last week's close. So even, with all the pain we've seen there, we don't have the valuation opportunity yet. So exactly how far lower it can go. I mean, quite a bit, right? Like often these things will kind of go to one standard deviation below the long-term average, and we're still above the average right now.
Well, what does this mean, Lori, in terms of why we're seeing those revisions? Is it just not materializing that companies are using AI or investing in AI at the rate that we came into the year thinking they would?
So, I think on the AI theme, probably the most interesting comment I've seen recently came from one of the software companies, and they had this, I'm going to mess up this quote just a little bit, but they said something like, don't DIY your AI, like don't do it yourself. And they were sort of lamenting, with their customers, all the wasted spend that had been done in this first tranche. And, so it's sort of, I'm certainly not an AI expert, right? But I read into this saying, okay, there's been a lot of money that's been dumped. It hasn't necessarily been spent smartly. And one of these companies, right, who wants to do all the spending and do all the work for these other companies is trying to call them out on them. So they're talking their own book a little bit, right? But I thought it was interesting because I do think there's been this sort of impatience, right? We want to see the results here and now. And if you haven't done that initial tranche of spend smartly, it's going to take more time for those, benefits to come into play, which at the end of the day, should still argue, right, for continuing to ramp up and build out the technology. But if there's been sort of this first round of disappointment, I think that helps explain, why there's been kind of this loss of sparkle on that AI theme as much as any of these other things we talk about.
Yeah, clearly patience starting to wear thin among some investors. Lori, I do want to switch gears and talk about politics. Of course, we are counting down to the election. There was a really interesting note out from Goldman today talking about, if you take a look at the different tax plans of Trump and Harris, when it comes to S&P 500 earnings, the impact could be in a ballpark range of 5 to 10%, depending on who actually wins. Now, I won't ask you to get that specific, but I am curious. I mean, a lot of people talk about the Trump trade, the Harris trade, et cetera, but when you think about their actual proposals here, how are you thinking about the long term?
So I think we have to be careful. The devil is in the details with some of these things. And Matt and I were joking earlier, I think I have PTSD from the Trump corporate tax reform that we did previously, because I think that, it was discussed for over a year. And what I remember about that period, right, was, we had all these companies, people sort of figured out the smaller cap companies are more direct payers of rates, right? So they benefited more from the number coming down. And people figured that out and pre-traded it. But what I really remember is when I was talking to the analyst community, the people who cover companies, a lot of people told me they're like, even after the legislation was passed, right, and you knew what the number was, they're like, we still don't really know how to model this. Like, we have to talk to our companies, and the companies are telling us they have to talk to Treasury, and they have to get guidance on all the implementation. So I think, people like me, we can go in, we can plug in, numbers in our model. The S&P effective tax rate, by the way, has been trending around 19%. It's been going up in recent years because of some of the foreign issues. So it's not even just as simple as the U.S. rate, but we can go in, we can change those numbers, we can come up with estimates. They're just guesses at this point, right? So I wouldn't tell people to really get overly excited about that kind of stuff at this point in time. We need the laws to pass, we need the regulations to be issued, and people to go out and do the work. By the way, it mattered for a little while. It was pre-traded. Even when all those regulations came out, the impact on the market was less. So, and it tended to be viewed by investors as this kind of one-time wonky thing that didn't really affect the business. So yes, it will affect headline earnings numbers and multiples and that kind of stuff. We might be over, emphasizing the importance at the end of the day.
I wish we could keep you longer, Lori, but I hope we can get you back soon. Lori Calvasina, their RBC Capital Markets head of U.S. equity strategy. Coming up, Verizon agreeing to buy rival telecoms operator Frontier for around $9.6 billion, but the target falls after the announcement. That and more in our Wall Street Beat. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market about 22 minutes into the U.S. trading day. You can see we're pretty flat on the S&P 500. The NASDAQ 100 actually poking into the green right now, up about 0.2%. We know it's been a brutal short week so far, but a little bit of relief today. Meanwhile, on the other end of the trade, you have the Russell 2000, your small caps. They were higher, now they're not, down about 0.1%, Sonali.
And it's time now, Katie, for the Wall Street Beat. We're going to look at some things moving under the surface. Verizon agreeing to buy Frontier for about $9.6 billion. The New York phone giant is looking to expand its high-speed internet business, and it's fascinating because the transaction, including debt, is $20 billion. This is a cash transaction. We love to see these cash transactions. Nordstrom yesterday was also cash, yet you have Frontier really taking a hit today. What is really happening? Is there uncertainty around this deal?
I haven't heard about any regulatory uncertainty here, although it definitely, will need approval. But Frontier's an interesting stock. It went bankrupt just in 2020, and some Wall Street names like Ares and Cerberus are investors. So maybe, there's like a liquidity issue of some kind. I've also heard that other transactions in the fiber space maybe have traded a higher multiple. So, it's unclear if we're going to see a bidding war for Frontier. So maybe that's why shares aren't up, but we'll look into it today.
To me, the most fascinating deal right now is the Nippon Steel attempted takeover of U.S. Steel, because both parties are determined to block this Japanese buyer coming in and essentially saving U.S. jobs. It's so weird, right? How is this going to work out if Nippon Steel really is blocked? I mean, are there any American buyers for it? Could it be private equity?
So Cleveland Cliffs was a name that we were all watching. They were involved in the bidding process last year for U.S. Steel, but now we're not sure they'd buy the whole thing. I'm sure the CEO would love to pick off bits and pieces. So this is a really tough position for U.S. Steel, and we do expect the White House to block this deal on national security grounds. And it seems to be the one issue that all politicians agree on, that this deal shouldn't happen.
And I mean, sticking in Japan, let's talk about the owner of 7-Eleven and, of course, Couche-Tard. What's going on with that deal? It seems like they've not quite aligned when it comes to the price.
So overnight, we saw the price leak out. We were wondering for days, what had Couche-Tard actually bid on 7-9. It looks like it's around $15 a share, which is not really a knockout offer, and in yen, you could see that the shares, aren't trading much higher than that. So from the beginning, 7-9 has been really defensive about potentially selling to Couche-Tard, and this news kind of shows that this deal is not happening anytime soon, but we'll still be watching to see how Couche-Tard responds. And I grew up in Quebec, so I'm watching this also really closely because it's big for Couche-Tard.
Liana, like 20 seconds here, but as the leader of a deals team here, are you surprised with the velocity of activity we've been seeing?
So it's a bit of a takeover Thursday. Sometimes, after Labor Day, we think there's going to be a big deal Tuesday, and we didn't see that. So it seems like it was a little bit delayed. But 2 of the 3 deals we talked about today are about deals maybe dying or not happening. So really the big news today is Verizon Frontier, which it's great to see something $20 billion enterprise value get to the finish line.
All right, very cool, Leanna. Thank you so much for joining us. Leanna Baker there runs the deals team for us here at Bloomberg. Just a programming note on Verizon. The CEO, Hans Vestberg, will be joining Bloomberg Television today at 11 a.m. New York time. We'll all be watching it very closely. You should too. Coming up in the next hour, HSBC's head of wealth and personal banking, plus Elf, eyes, lips, face. Elf Beauty's CEO. And the founder of a new CFO, and the founder of a new sports-focused real estate firm. Jonathan Facitelli joins us around a really interesting story. Will the 76ers actually move from Philadelphia
to New Jersey?
Camden, New Jersey? We'll ask him. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning. We are broadcasting live from the Bloomberg Power Players Conference. We're at the 6th floor of the Bloomberg Global Headquarters here in Midtown Manhattan. Got a lot of sports people today for you, Alex.
Sports.
You're fired up about that. Production coming to you, technically, Chris Machkowski, the Mount Rushmore of New York sports radio technician. Production guys. He's here. He's making it all happen. We appreciate it. That's the highlight of my day.
Actually, he should co-host for me.
Yeah.
Yeah, we should swap out.
Yeah, yes.
I'll do audio. You sit here.
Exactly. Steve Miller's going to join us. He's the chair of ISM Services. We're going to get some ISM data in just moments here. We're also going to talk to Randall Williams. Bloomberg U.S. Sports reported. He's going to give us a preview of this conference here, this big take story here. Billionaire NFL family eyes windfall from Wall Street. Private equity is coming into the NFL. That's going to be huge for valuations. Brittany Whiteside, Vice President, ASP College, Atlas Sports Partners, on how the economics of intercollegiate sports are shifting. Are they shifting in a big way as money goes to intercollegiate sports? Right now, let's get a start of this show here with Mr. John Tucker. He's got a Bloomberg Business Flash for us.
All right, Paul and Alex, we are data dependent, so let's start with the ISM Services Index, reading on the biggest part of the economy. It continues to expand. The index coming in at 51.5, a little better than expected, a little better than the last reading. And on the data front, earlier today, we got the ADP report showing U.S. companies adding the fewest jobs since the start of 2021. Of course, this comes ahead of the jobs report tomorrow. That may tell us 25 or 50 basis point cut for the Fed this month. John Stolfus at Oppenheimer, meantime, says now is not the time to get defensive with stocks.
Where we are today is we are in the process of a normalization, moving towards sustainable growth at a pace where we don't grow inflation too hot and yet we do not destroy the labor market.
Right now, the S&P 500, 22 points higher. That's up 0.4%. 55.42 on the index. The Dow Jones Industrial Average up 17 points. 40,988, and the NASDAQ 100 up 141 points. That is up 0.75% right now. Let's look at shares of NVIDIA. They are up 2.9% right now. Verizon agreeing to buy rival telecom operator Frontier Communications for about $9.59 billion. Frontier shares, they are actually down right now, down 9.1%. And we're brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. We're just one floor away, but we feel oh so far.
Yes, we do. We're up. The sixth floor at the Bloomberg HQ is kind of the central command. Everybody just kind of comes in here, grabs some food, grabs a cup of coffee, then kind of heads off. Yeah, it's the hub, and then heads off to their desk.
It is definitely the hub. All right, we're taking a look, though, at the eco data that just crossed, right? You know, ISM manufacturing had come in weak earlier in the week. U.S. services sector expanding at a modest pace for the second month in August. ISM service a little changed, about 51.5. Now, remember, readings above 50 still indicate expansion. So we want to get right to the guy behind the data. Steve Miller is chair of the ISM Services PMI. Hey, Steve, what do you make of the data today?
Well, we're encouraged to see the second month in a row of growth, and it's the 6th month out of the year that we've seen growth. So definitely encouraged. One of the things that was one of the sub-indexes that was a bit of a surprise was backlog dropping significantly, down to about 43%. And what we attribute that to is a lot of the commentary has been around improving supply chain performance and utilizing capacity to catch up. So we attribute that to maybe catching up on late orders that were impacted during supply chain disruptions earlier in the year.
So give us a sense of what this means, do you think, for the Federal Reserve? How do you think the Federal Reserve will look at an ISM index that's still showing some positive growth there at 51.5?
Yeah, I think it's very consistent with going forward with the rate cuts. It's the lowest rate of increase that we've had historically. There were only three readings last year that were lower than this month's reading. And then going back to 2022, only December's reading was lower than this. So we're seeing growth, which is positive, but all the indicators in the data are showing very slow growth. And some of the indicators as far as costs and costs continuing to impact, as well as interest rates continuing to impact investment. Seems like now's the right time.
All right, Steve, we appreciate it. Thank you so much for that instant analysis, Steve Miller, the ISM chair for services. And the S&P kind of taking it in stride. It's weak, but it's not collapsing. And you got the S&P up by about 0.4%. Let's dig inside some of the market stories here. Bailey Lipschultz, Bloomberg's senior equity reporter, is joining us here on set. He also is so far away, but he's close, but he's far. All right, Bailey, what are you looking at right now?
Airline stocks outperforming this morning. Led by JetBlue, was up more than 5%. Still in the red for the year. This coming after they raised their sales forecast for the current quarter, saying they benefited from an unnamed rival airliner. I don't know if you guys remember one of those companies that had some issues with their flights, but saying that revenue uplift.
There were a lot of them, so it's hard to kind of keep track on that point, but yeah, go ahead.
So saying that the according to management, revenue uplift from the reaccommodation of customers affected by other airlines cancellations helped provide a boost for this quarter. But we are seeing really across the board, United outperforming, Delta Airlines outperforming as well, as was Southwest. So really seeing maybe a bit of investors either short covering or getting back into some of these airline stocks that, to put it bluntly, have had a rough go of it over the last 12 months.
Yeah, and I never relate, just from my own personal experience, it seems like every time I go on a plane, which I try to avoid doing unless I'm getting paid to do it, packed.
Yeah.
I mean, you know, so I would think the load factor, which I know is a big profit driver for these airlines, would be pretty good.
Yeah, it does seem like consumers are still spending up. I think the airlines, depending how you want to, what lens you want to view it through, maybe got a bit greedy or a bit over their skis in terms of price hikes and trying to expand margin, and really maybe that spooked some consumers. But we are still seeing what really seems, at least when you look at results from the likes of a Target or a Walmart, a more cost-conscious consumer. So maybe that revenge travel is kind of reversing.
All right.
I have no travel. I got negative travel. HPE, Hewlett-Packard Enterprise, that stock is down about 6.5%.
At one point, it was down 10%, that biggest decline in quite some time. This coming after the computer hardware and storage company had weaker than expected margins. That offset a tailwind from AI-related demand. Yes, HPE has been one of the many companies pounding the table on their benefits from artificial intelligence. Some analysts kind of weighing in, saying that while AI systems saw double-digit growth in the last quarter, investors really want to see that show up when it gets to the bottom line, when you see that, when you look at kind of free cash flow, when you look at margins, and it does seem like gross margins outcome for the quarter really playing into the investor uncertainty as it relates to how HPE really can be better positioned to kind of continue to grow and expand its business, again, in a year that has continued to be dominated by artificial intelligence.
All right, what else you got?
Zimmer Biomet. I don't know if either of you guys are familiar with it.
Biomed.
ZBH. They do knee and hip replacements. They're down as much as 7.9%. Biggest drop since February 2022. CEO saying that they expect software issues will hurt their revenue in the second half of the year. They switched their enterprise resource planning platform in early July. This coming from the CEO making comments at the Wells Fargo conference, basically saying as they got into the August timeframe, things weren't working as quickly as they expected. So continuing to see challenges through the end of the year. ZBH, one of the worst performers in the S&P 500.
All right, very good. Bailey Lipschultz, appreciate that. Bailey Lipschultz covers the equity markets for Bloomberg News. Alex Steele, Paul Sweeney, we are live here at the Bloomberg conference here in New York. It is called the Power Players, talking about the convergence of sport, business, entertainment, technology, all that kind of stuff, all coming together. And so they've got a great lineup of folks here today talking about that. And we're going to interview a handful of some really smart people coming up over the next couple hours that are going to be participating in this conference. We'll talk about that coming up. But it talks about the big business of sports. And the most recent news is private equity is now going to be allowed to invest in part in the NFL. So you think about the...
I hear this is a big deal.
This is a big deal because, the private equity's got tremendous amounts of capital. And the NFL valuations have been just going so high that individuals anymore almost are priced out of the market. The old, when families used to own these NFL franchises, that's becoming less and less of an instance. You need big institutional capital, and that's kind of one of the stories that they'll be talking about today.
And alternative investments,
Exactly.
I go right to where I want to talk about, is definitely the thing, right? As you have more money and it needs to find more opportunities. And luckily, the Bloomberg Big Take today sort of helps set all of this up for us. Randall Williams is one of the authors on it. And the title is The Billionaire NFL Family Eyes Windfall from Wall Street and the Swifties. And this really focuses on Dan and Clark Hunt controlling a $6.5 billion empire with a portfolio of teams across the nation, from the NFL, Major League Soccer, and the National Basketball Association. I read it. I read the sports, and it was a great read. I learned a lot, actually. Randall Williams joins us here at Bloomberg headquarters. Hey, Randall, walk me through what you learned about this family and how it runs itself and sort of all the different branches they have in sports.
Yeah, you said it, or you mapped it out. Oh, there go my glasses.
It happens.
But yes, you mapped it out. They have a majority ownership of the Chiefs, of FC Dallas, and then an 11% stake in the Bulls. So they are one of the premier sports families across the country, and I'd say across the world too.
What are their ambitions here for just sports in general going forward? As you mentioned, they have diversified ownership. Obviously, their biggest asset is the Chiefs, which they've owned forever, it seems like. Where do they want to grow going forward?
Well, it's all in sports. I mean, one of the things that Clark and Dan Hunt have talked about is the opportunity to grow in soccer. I mean, the World Cup will be here in 2026, the Olympics in 2028. That's a tremendous opportunity to grow soccer domestically. Anyone who knows, and I should say football, but,
I know, this is going to get confusing, right? Because, like, soccer, you play with your feet, so that should be football.
I'll say soccer to stay American. But anyone who knows soccer knows that it is the giant internationally. It isn't here the same way domestically. The World Cup provides an opportunity for that. At the same time, the NFL has an opportunity internationally because that's the giant domestically. So the NFL is trying to play more games internationally. They're trying to grow their business internationally. So those are the two opportunities.
Versus actual football, like especially if they try and grow abroad for the NFL.
Well, I think that when you go abroad, you adjust, and It's a question for the commissioners and how they want to market it.
Okay. Do we know what the answer is that going to be?
I think football is going to stay football.
It's going to stay. Okay.
And you know, there'll be a budding rivalry between the two, a quiet one. But as long as everybody's making money, then, you know, it keeps everybody happy.
Fair enough.
All right, so talk to us about private equity. That was kind of, for me, being a Wall Street guy, the big news in sport over the past couple of weeks. And Clark Hunt himself led the committee within the NFL to kind of address this issue. What is their thinking about private equity? Why did they go down that road?
Well, I heard you talking about this a little earlier, but the reality is, if you're selling a 5 to 10% stake in a franchise that's worth $6 billion, that's $300 million or $600 million in cash, and the valuations are only going higher. How many people can write a $300 to $6 million check, even if it's discounted? Let's say you take $50 million off. That's still a lot of money. Even the richest athletes in the world don't have $200 million in cash to just send to a team. And this is a long-term investment. You're not getting that money back tomorrow. You have to be in this for the long run. And so with that, if you're selling to an individual, that individual isn't going to come in and just want to sit on the sidelines and say, oh, yeah, I have a piece of a team. No, they might want to ride on the team plane. They might want an ownership suite. These owners, and a lot across sports, period, have inherited these teams over time. They are very, very, very close and prized possessions. That means that they don't want to let an individual who they may not know in. Private equity is a solution to that. They want returns on their investment. They're not going to look to be riding on a team plane, maybe
They have their own planes.
Exactly. Exactly. So they'll be willing to be quiet investors, is what I'd call them. And so it's a solution. But the most important detail that I think I'll be saying for years to come is that both Jerry Jones and Clark Hunt said that this was a positive day, not a happy one. It's not something that the owners want to do. Quite frankly, I think if they were making more money, that doesn't mean that they're not making money. But if they were making more money, they wouldn't be allowing this. But these are providing solutions to secession issues, to stadium deals, to giving liquidity to owners who might not have the cash that they want. So that's setting the landscape for private equity.
And I noticed that, you know, the Hunts, they had a defeat recently in that they weren't able to get, I guess, the municipalities surrounding their stadium in Kansas City to help them renovate the stadium, or maybe even a new stadium. What's the future there? Because I look, a lot of people look at the Kansas City as maybe over the last 5 years the most successful franchise in the NFL, and our people tell you the stadium's terrible.
Yeah.
relative to the new stadiums being built that are just
It's
amazing.
an older stadium. I'd say that. I think that there's a nostalgia feeling around older stadiums. However, there's a reason they're looking for this money to renovate, because it needs renovation. So what's going to happen next? They've tried at the local level. I think they'll go to the state. But they've also opened a door to going across state lines to the state of Kansas. So all options are on the table. Do they want to leave Arrowhead Stadium? No, absolutely not. Clark will tell you that. The team president, Mark, will tell you that. They don't want to leave Kansas City. But the reality is this is a business, and this is a money-making business. If it's going to cost them more money to stay in Kansas City as opposed to going to Kansas where they might be able to build a stadium, they're going to do that.
Okay, talk to me about today. Power players.
The fun day. Party day.
It's a party day for you, and I get to learn about sports. So together, we are united. What panels are you going to be moderating? What are you excited about?
I'm on 2 college sports panels. We have Deja Kelly, Brittany Whiteside, Tim Pernetti, all prominent people in college sports who are in the business of it. We also have Open Door CEO Blake Lawrence. They'll be speaking at Blake Lawrence and Brittany Whiteside will be speaking at a lunch panel, and then Deja Kelly, Tim Pernetti, and again, Brittany will be speaking on another college sports panel. So those are my 2 today.
Tim Pernetti, formerly of Rutgers, great in the Big East. The big thing in college sports is I think it's the Wild West here in terms of the dollars going around. NIL, name, image, and likeness.
Correct.
You got $20 million rosters out there, and it's only going to go higher. Somebody's got to step in and regulate this thing. Who's going to do it?
Who knows?
It can't be the NCAA.
We'll find out today.
All right.
We'll find out today. I mean, listen, if there was an easy solution to this, I think we'd have it by now. The NCAA is going back and forth to the Supreme Court, it feels like, every other week on what it can regulate and what it can't regulate. What that means for the athletes, it's a great time.
Yeah.
It's a great time. You can get money just about everywhere legally. I mean, there's some infractions here and there, but if you want to go into sports as a college athlete right now, the reality is you can go to Rutgers, get $100,000. You can go to Texas, get $500,000, and then you can go to Florida and get $1.5 million and never touch the NFL.
Can you imagine being 19 and having that? I mean, like, no way would I know what to do
I'm
with
going back to school.
Yes.
I'm going back to school.
I'm definitely built for sports.
Lace them up.
Me and soccer. And we'll talk to Brittany Whiteside actually just right after this break. So great stuff. Thank you so much, Randall. Really appreciate it. Good luck today. Enjoy yourself.
Thank you.
Looking forward to the rest of the panels. Randall
this
Williams.
Was fun.
From Bloomberg, and Brittany Whiteside coming up. She's Vice President of ASP College of Atlas Atlas. I can't read today.
Oh, yes, we
Sports
got Sun in
partners.
the kind of
We got Sun.
issues.
It's hard. Change is difficult. Anyway, we're very excited. She'll be talking to us right after the break on this sports Thursday.
Yeah, exactly right. So, I mean, we're taking a look at this. And again, the business of sports has become just a huge business, and it's getting even bigger, as Randall was saying, particularly in the amateur ranks, with the NCAA. It's big business, and the athletes arguably should get their piece of it, and they are. We'll take a look. Well, more coming up. This is...
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This is Bloomberg Business Flash. Right now, we have 5 of the 11 major industries in the S&P 500 higher, being led by consumer discretionary and information technology. Tesla is the best performing stock in the S&P 500. The U.S. services sector, this is the biggest part of the economy, expanding at a modest pace for 6.8%, and most active shares of NVIDIA. NVIDIA shares right now up 2.4%. The U.S. services sector, this is the biggest part of the economy, expanding at a modest pace for a second month The ISM index of services little changed at 51.5. Readings above 50 do indicate expansion. And then some of the specific company news. Verizon agreeing to buy rival telecom operator Frontier Communications parent for $9.59 billion. Verizon is hoping to expand its high-speed internet business. Frontier investors will be getting $38.50 a share, and that represents a 37% premium to yesterday's close. S&P 500 right now 20 points higher. That's up 0.4%. We're at 55.39 in the index. Dow Jones Industrial Average 20 points lower at 40,953. The Nasdaq 100 right now up 144 points. That's a rise of 0.75%. A 2-year yield 3.76. The 10-year yield 3.74. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. We are live at the Bloomberg Power Players at Bloomberg Global Headquarters right here in New York. The summit's bringing together industry leaders at the intersection of sports, business, and technology, a.k.a. this is the day where Alex learns more things about sports,
yes,
which I think
exactly.
everyone will be very helpful to hear about. Joining us now is Brittany Whiteside. She is Vice President at Altius Sports Partners, and she has a long career in this area. Before this, she was a trustee at Whiteside, served as an executive associate athletes director at the University of Virginia in Charlottesville. She was also a member of the department's executive leadership team and has been deeply involved in college sports for quite a long time. Brittany, thank you so much for joining us.
Thank you for having me.
Okay, this is where you get to dumb stuff down for me. So college sports, I know, is definitely changing.
Yes.
How is it changing and how quickly is it changing?
You know, it is changing rapidly. Probably in the last 3 years, we've seen some of the most change in college sports, but also in the industry at large. We have the implementation of NIL. I'm sure you've heard of that. That's a buzzword, right? Now athletes can earn money off of their name, image, and likeness. And so when you talk about college athletics and change, and you think about that in the last year, in the last 3 years, that's the biggest change. And now we're at a point where we continue to see the change. And you have the House settlement where schools may be able to now pay athletes directly. And so as you think about college athletics and the business model, it is completely shifted, and leaders across the country are preparing for that.
All right, to me, it's all about the economics, and I think most people agree that given the money behind big-time college sports, that, in fact, the athletes should be compensated for that. The question is NIL the way? It doesn't seem like it. It seems like rudimentary at best. There's no regulation. There's no way to ensure an even playing field. Where do we go from here? It seems like we open a Pandora's box and we have no idea.
Yeah, well, I agree with you. It is the right thing for athletes to be able to earn money off of their name, image, and likeness, so be able to monetize that, right? NIL was the first step in that, the ability for athletes to go out and to earn income, whether that is through working with brands or in some spaces, you probably heard of collectives in this space as well, you know, helping athletes generate money off their name, image, and likeness. Where do we go from here? You know, we have the pending House settlement, which as we sit today, the judge will hear arguments against the fairness of that House settlement, right? House settlement is really the next step in the framework for college athletes and athletic departments to be able to share in that revenue, right? It's a revenue sharing proposal. And so in terms of next steps right now, it is the pending House settlement and next steps for athletes to be able to be paid directly from institutions versus brands and collectives and all of the other areas. And then there will be some upcoming regulation to that as well.
Right.
What about, I mean, that this is tied to a college or university is also just so odd. Like, this is like a professional business that one can be a part of, but yet you're going to be 19 years old also expecting to, like, go get your GPA and do well in school. How does all of this going to coexist?
You know, it has coexisted now for a while, and, you know, that was a major concern of mine early on, is how are athletes, how are college students going to be able to navigate this? And what we've seen is they've been able to handle it well. Some of them engage in the NIL space and do so in a way, in meaningful ways, where they're getting internships and opportunities and skill sets that they did not have the opportunity to get before. So when you think about NIL, you think about managing your brand. you think about negotiating. All of those skills are skills that you need for life. And so as part of being a student, part of that is preparing for life after, your time on campus for 4 or 5 years. And so NIL in many ways has been handled for students as a great opportunity for them to leverage their brand and be able to generate money and help prepare them for a future.
I guess the other big issue in college athletics has been the realignment of conferences, and now we've got my poor, Rutgers field hockey team sleeping on the floor of Newark Airport because they're taking a flight out to Stanford.
Yeah.
Stanford in Palo Alto. What's going on there? How is this going to evolve, do you think?
Wait, why is that bad? Why is that weird?
Because now Stanford on the West Coast is now part of the ACC, part of the ACC.
Gotcha.
So they got to go fly from Palo Alto to Durham, North Carolina.
I get it.
And I can understand that for the football team. They're on a charter jet, all kind of same thing for basketball. But how about for like the smaller sports? How is this impacting?
Yeah, that's an interesting dynamic when you think about some of the Olympic sports, right?
Yeah.
And you talked about what are some of the things that we still need to figure out. In college sports, I think that's part of it. Conference realignment as a whole, mostly driven by football schools that are competing at the highest level with schools that want to compete at the highest level. With that comes other Olympic sports that it may not make as much sense economically for them to travel or for student-athlete experience for them to travel. But when schools and institutions want to compete at the highest level, that is part of it. And so right now, many schools are having those conversations on where do we want to be in this landscape? Do we want to compete at the highest level? And if we do, that may come with your field hockey team traveling across the country to compete against the best in the country.
But then they still have to go take a test and do grades. I mean, that's something.
You have Wi-Fi now. They're taking
I guess
exams
that's true.
remotely.
Okay. Fair enough. What do you think that athletes could be doing better though right now?
Oh, it's such a key time for athletes to hone in on who they are, their identity, how they can manage themselves.
Because we all knew that
a
at
brand.
19.
I know, right?
Yeah.
But also, they are also engaging responsibly and thinking about what are some of the brands that I work with on, or a coffee shop that I always go to, a local coffee shop. How can I utilize my NIL with that local coffee shop to create a partnership, right? And so, that's how athletes are navigating it now. They're navigating at the local level, and then also they have schools that are putting resources together to help educate them on how to really navigate it in a way that is best for them.
What do you advise schools to do as they think about how to really implement an NIL and take care of their student athletes? What are you recommending as a kind of an overarching view?
Yeah, absolutely. It always starts with education. And so early on, it's educating the athletes on what NIL is, what it isn't, how to build their brand, how social media plays into this, how this entire ecosystem works. The second part of that is as a department to really hone in on your strategy. How are you going to invest in the resources for your athletes to be successful in this space? Like you would in strength and conditioning, like you would in nutrition. This is another part of the student and athlete experience that as an institution, it's your responsibility to invest in resources so athletes can really optimize their NIL while they're on their campus. And for some of the athletes, this is their time to earn
their prime
income.
time.
This is their prime time. Some are competing at a national level on TV. And so as an institution, it's like, how can we utilize our network, our resources, our institution IP to help athletes generate revenue and generate income for themselves?
Well, because that's why we see a lot of former pro athletes now investing because they were able to take control of their money, and they have so many stories. Like when we talked to A-Rod a few months ago, they have so many stories of their peers that were given all this money in a really short amount of time, and your earning power is so limited when you're so young, and then it's gone. Like it's not a sustainable business model like Paul and I might have. What do you think that the media rights world, like as we change from traditional TV to streaming, all of that, how is that impacting college sports?
I think it will continue to evolve, and that's happening in college sports at the conference level as the conferences really hold the media rights to those sports in that entertainment space, right? And so I think it will continue to evolve. I think it's going to continue to be a big money area in college athletics is the media rights. And I think it's to be determined on what the future structure of FBS football looks like and in college basketball and those other things that really may take form as some of these media contracts are coming up for renegotiation in the coming years.
How about we all think about football and basketball driving it. How about the NIL and the money? Is it there for women's sports? Is it there for the Olympic sports, as you refer to them? Is it trickling down to the football, basketball thing.
Yeah. Yes, with the institutions we work with, we are seeing it trickle down. Now, not at the same level as football and men's basketball, but we are seeing athletes in Olympic sports, primarily women's sports. We just had a school that announced that they had a women's sports sponsorship that included NIL, right? And so you are seeing more brands. And I also believe that women's sports are doing a really good job of leveraging their personal brands. And they're really figuring that out earlier, right? And it's a time for women's sports right now. So there's definitely more attention and support, and that is trickling down to women athletes on campuses as well.
So how does the partnership wind up starting? Like, is it the athlete taking control and going, like you said, the local coffee shop, et cetera, and being like, hey, here's what I got for you? Or is it, someone goes to watch a game and they're like, that athlete's awesome, or I like their personality? Like, how does that evolve?
So it is both. So part of it is on the athlete, and athletes that do it well are reaching out to
That's
brands.
amazing.
Some of them have representation. Some of them have agents that are negotiating partnerships with them. And then you have the school, and you have donors and supporters that have created these businesses, these enterprises called collectives, that if they have a donor that wants to support that athlete or that sport, that donor would give to that collective, and then they would, find opportunities for the athlete to get that money.
And it seems like with the collectives, I'm seeing it, I'm hearing it, I'm reading about it. There's definitely the haves and have-nots.
For sure.
A certain school that I'm familiar with, their collective in their first year just dwarfed everybody else. And it's a handful of phone calls. That doesn't feel right.
Yeah.
How does that change? How does that shift?
Well, it will come directly from the university.
Yeah.
So you'll take out the collective as a middleman.
Yeah. There are certain things that may regulate that collective space a little bit more, but right now, as you have the pending House settlement, schools will be able to share in that revenue directly with athletes. So you still will have collectives in this space, right, that will play some role. But long term, it's really to be determined on what that looks like, as there may be more regulation coming in that space.
You're absolutely right. The change in college sports is just, breathtaking.
Amazing.
So, it just seems like how these universities are going to deal with this.
I knew I should have put my daughter in something meaningful when she was 3.
Exactly.
Darn it. Hey, Brittany, really appreciate it. Thanks very much. Brittany Whiteside, Vice President of Altia's Sports Partners. A really great conversation there. Paul, I'm looking at these markets, and we're looking at a semi-rally, and I say semi-rally because the NASDAQ is up by about 1%. The S&P is up 0.3%, but the Dow is flat. But it doesn't feel like it's anything particularly meaningful. And the bond market also is just a little bit meh as we got that that ADP number that disappointed, and then as we head into tomorrow's jobs day.
Yeah, jobs day tomorrow. Interesting to see. There's some folks saying be prepared for a number that's way off consensus, and in either direction, it could have an impact on the market, because that's clearly what the Federal Reserve, one of the key data points that it will be looking at.
Yep, and also, I would not want to be an economist. I have to make a prediction.
No.
Let's just put it that way. All right, coming up next, a conversation about women's soccer.
Yes.
Super pumped. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. The major averages mixed right now. Tesla, the best performing stock in the S&P 500. And among the most active, shares of NVIDIA. Shares of NVIDIA right now up 2.3%. Tesla shares, they were up 6.1%. A Bank of America analyst writing that the recent sell-off in shares of NVIDIA has created an enhanced buying opportunity. Well, traders now waiting for tomorrow's all-important jobs report. A rate cut by the Federal Reserve this month seems baked in the cake. And Deborah Cunningham at Federated Investment says the size is going to depend on that payroll report.
In order to go 50 basis points, it's our opinion that we need a payroll print that is somewhere in the neighborhood of, maybe zero or negative.
America's service industry is expanding at a pretty lackluster pace for a second month. The ISM Service Industry Index, little change in August, running at 51.5, readings again above 50. That signals growth. And just ahead of an interview with the CEO of Verizon, the company agreeing to buy rival Frontier for $9.6 billion in cash. S&P 500, 14 points higher. That's up 0.3% at 55.35. Dow Jones Industrial Average, 66 points lower. That's down 0.2%. And the NASDAQ 100 up 135 points. That is a rise of 0.7%. The 10s, 376. Two-year yield, 378. That's up 2 basis points. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm John Tucker, and that is a Bloomberg Business Flash. Paul and Alex.
All right, JT, thank you so much. We are broadcasting live from the Bloomberg Power Players Conference at Bloomberg Global Headquarters in Midtown Manhattan, bringing together a lot of the smart folks in the business of sports, the technology of sports, and the competitiveness and the economics of sport. I'll tell you what, in the last 3 or 4 years, women's sports, in terms of popularity, audience, ratings, it's just, I'm not going to say exploded, but really had a noticeable surge, in my opinion. Think, for example, Caitlin Clark with the basketball. But I think it all started with women's soccer, the success of the U.S. women's soccer program, a team in the Olympics and the World Cup and all that kind of stuff. And now the National Women's Soccer League. Jessica Berman joins us. She is the commissioner of the National Women's Soccer League. She joins us here at our Bloomberg conference. Jessica, talk to us about the state of the National Women's Soccer League here in the U.S. It seems like it's just growing dramatically. And I know you've got some news about some ownership out on the West Coast, which really caught my attention, being a former analyst covering the Walt Disney Company. But talk to us about the league right now in women's soccer.
In the last 2.5 years, it is true. I think women's sports and the National Women's Soccer League in particular has exploded. We've reached this inflection point where it is no longer a question whether investing in women's sports is a good business investment. And because of that, the money has followed. And we're looking at our ownership group across all of our teams, 14 teams across the country, and we have the right capital and strategic investors around the table to really build for the future. Talk about our recent announcement this morning. Bob Iger and Will Obey are now the control owners. It is a boom. It is a mic drop. Are now the controlling owners of Angel City, which are the highest enterprise value women's sports team in the world.
Oh, wow.
Traded for $250 million. And, this is a league that launched 12 years ago. Angel City is only 3 years old.
Los Angeles, yep.
If you put that side by side with the men's leagues that have been around for decades, some more than 100 years, it's really incredible to see the amount of growth. We also announced this morning that Magic Johnson is an investor in the Washington Spirit with Michelle Kang. So the type of owners who are coming to the table to really invest in this is really driven by the future vision of a view that we really can be the best league in the world. And because of the backdrop, as you mentioned, of women's soccer, it's just an incredible moment to be part of witnessing this growth.
Well, I was going to ask as to the why now part of it. Is it because you've had, super good success with some amazing players in the game? I also, as a finance nerd, am going to go back to the Fed had 0 interest rates for a really long time. There was a lot of money that needed to be put to work, that needed a good return because you couldn't put it in the bond market, that kind of stuff. What are you hearing as to why people with money think this is a good investment now?
I think if you look on a longitudinal basis, particularly at men's sports as a parallel, over the course of decades, it outperforms every other asset class on a long-term basis. And so you've often seen investors who are long-range in their thinking around putting capital to work invest in sports and see incredible returns. If you look at that compared to the product of women's soccer, there really is no reason why we should not be as successful as men's sports, particularly in a sport that has the backdrop of when you think of success and soccer in the US, you actually think of women first. And that really creates a unique value proposition that has really woken up the investment community to say, if we look at men's sports and the way that they've grown in enterprise value on an exponential basis over decades, and we are at the inception of our growth, there's very few things in the world that you can get in at the ground level. I think we're definitely beyond the ground level, but we're certainly nowhere near the top of our hockey stick growth.
Media rights, it's the big driver of global sports valuations globally. What's the media strategy for U.S. Women's Soccer League?
Yeah, we signed a landmark media deal and announced it in November of 2023. We got a collective $250 million invested into our league from the combination of CBS, ESPN, Amazon, and Scripps Ion. And in addition to that incredible investment in our league, which allow us to put those resources to work to grow the league, we've also made the very important strategic decision to also invest in ourselves and ensure that our games are viewable and discoverable on platforms that are national in scope and scale. And so from last year to this year, we went from 6 games being available on national broadcast to over 120.
Wow.
Oh my gosh. So now when you are sitting on your couch, which some people still do, and channel surf, which some people still do, you will find our games. And if you were watching the US Open the other night, which I was, and there was a promo ad to tell everyone that you can watch this weekend on ESPN. If you were watching CBS Mornings this morning, you saw a promo ad that you can watch the NWSL on Saturday on CBS. And so we are in the places and spaces where people consume live content, and that will help us to catalyze the growth of our audience.
So I don't have cable. So what about streaming? Like, how can I find it on my Apple TV?
Yeah, so all of our CBS games are also on Paramount+. All of our ABC and ESPN games are also on ESPN+. All of our games on Scripps Ion, you can also watch through like a Pluto TV or other streaming apps that provide access to over-the-air platforms. And obviously, Amazon Prime is basically ubiquitous with national distribution, both streaming and anywhere else that you would want to watch.
Jessica, how about talent here, the players? I mean, you could do a whole league with the University of North Carolina. That's such a great program for so long. And as a Duke person, I hate to admit that. But it's an international game. It's a global game. Can international players come here? Because I know that's a problem for the U.S. Men's League. The U.S. players, the great international players, don't want to come to the U.S. League relative to Europe. What's it like on the women's side?
Messi did. There's that.
Well, unless you're at the end of your career, you're looking at cash in.
I think that is, and I appreciate the question because maybe I should have led with that in the answer to why invest in the NWSL. We are the best league in the world. And we are at the top of the pyramid as it relates to attracting talent. And we have a lot of the best players playing here, not just the U.S. Women's National Team, but we look at, for example, the Olympics this summer, where we as a league had 57 players competing for 11 of 12 teams in the Olympics. If you looked at the gold medal match, we had the majority of the players on the pitch, both for Brazil and for the U.S. team. We had 27 players competing between both of those teams. And so we are a global league. We've actually recently changed our rules to allow 9 players on the roster be international players because we really want to be a league that is a destination for the top talent in the world, which now is not just in the U.S. There's top talent everywhere. This truly is a global game, and we're excited to be a destination for the best players.
All right, Jessica, thank you so much for joining us. Really appreciate it. Jessica Berman, she's a commissioner of the National Women's Soccer League. You talk about the growth of women. Again, in my opinion, kind of led by the Women's Soccer League, and it's just been extraordinary. It continues to grow, and as a media person, when you see the money, the rights start to go to a particular sport, that's where you know that the growth is and the opportunities, and that's certainly the case with the U.S. Women's Soccer League. We're going to have more coming up from Bloomberg. This is Bloomberg.